You brave enough to sell the outperformers at this point after the rally that we've seen?
And you sent round a piece by our colleague Michael Masika quoting a number of strategists saying for market forecasters, European equities have little or no upside for the rest of the year. That's quite incredible, isn't it, after the rally that we've seen, which isn't focused in Europe.
No, it's not. But in the States, you've got strategists upgrading their numbers.
Right.
A whole range of them are now upgrading their year-end forecast.
So a whole new divergence.
Is it braver to buy in at this stage after the rally?
Well, yeah. I don't know. you brave to sell or you brave to buy? I think a lot of people are kind of rabbit in the headlights right now, don't know what to do, but the market keeps rallying. Anyway, talking of that market rally, got a little bit maybe of upside to come through today. We'll let the FTSE 100 settle down a bit. It's absolutely flat at the get-go, but the expectation on the fair value is that we'll see a little bit of a tick higher, maybe a little bit still to price in out of the US session yesterday, which was super strong. But I don't think you're going to see the frenetic action that we saw yesterday. Maybe Stephen's right, we get back to maybe focusing on some of the other single stocks that we need to be watching.
Well, talking of that, we had this week a lot of mining companies reporting, and today we have Basic Resources at the top of the pile. So it's Anglo-American, Rio, these types of businesses that go higher during the week, of course, driven by earnings stories, maybe now driven by what the underlying metals prices are doing. But yeah, technology was the biggest gainer yesterday. It's flat today. It's taking that break, Guy, that you suggested.
ASML coming off a little bit, so you're seeing maybe some of the steam, a tiny bit of the steam maybe coming out of that sector. I think we're going to see more European tech names reporting numbers next week. HSBC bounces back a little bit. Some of the luxury stocks are up as well. I wonder if there's a little bit of a China theme in the market this morning. The mood music appeared to be a little bit better in China this morning, and I wonder whether that's translated across into what we're seeing here in Europe.
Although that warning we heard from Standard Chartered's Bill Winters earlier as well, that he's not sure that he can say that China's bottomed out either. So there's still uncertainty there too. By the way, I was wrong about Allianz, down 1.25%. That share buyback, not enough to impress.
That's the most weight. Allianz is the most weight on the market at the moment. It's not a big move down, it's 1.5%, but yeah, that's where the weight's coming through.
It was interesting. Yesterday we were joking with a few executives we were talking to in the breaks before going to them for earnings conversations about what their shares might do when they report the day after Nvidia.
Yeah.
They all benefit, don't they?
There was a huge tailwind yesterday for everybody. If you report numbers today, you don't get that tailwind.
No, exactly. Something to consider for future, unless the Nvidia story changes and we're not gaining in quite the same way. We do have a few sectors in negative territory now. I can see that utilities is one of those, insurance, construction. Basic Resources still doing the best. Up 0.3% on the FTSE 100, pretty flat elsewhere. The DAX not yet open. It's still recovering.
Yields are ticking higher, though. Keep an eye on what is happening there. Just kind of in the background. We were so obsessed with the macro, weren't we, at the beginning of the year? It was all about the Fed. It was all about Fed positioning. That was going to be the driver of stocks this year. Fed was going to cut. Stocks were going to go higher. Stocks go higher regardless of the Fed.
And it was really interesting because we were obsessed with the Fed, and stocks went higher. And then you felt like if the Fed got pulled away from us, that we'd have to drop before finding the next thing to rally on. But it seems as if the market has just stepped over the Fed and gone, okay, sure.
It's just
strong growth,
hold
AI,
my beer.
I'll buy that.
Stocks go higher, seems to be the narrative. But yields are continuing to tick higher. I thought Holtzman was quite hawkish this morning.
Yeah.
I thought. So, and then that narrative continues, and it's the same in the States.
Yeah, I mean, look, the message from the Fed speakers we had yesterday was be patient. I think the markets are telling the Fed to be patient as well because they're not that interested in what they have to say right now.
What I think here is interesting is there's a wealth effect that comes back. Stocks go higher, that creates more reason for consumers to feel buoyant. That spurs more spending. Yeah. We had the Accor CEO on a little bit earlier. he came in and said, I'm going to have to be kind of tone it down a little bit. He was really positive about the outlook for his business.
We talked about tipping points in AI, and that's the investment cycle story. But tipping points in terms of consumer psychology, if we see today and over the weekend, papers and websites are full of stories about stocks at records, that has that wealth effect, doesn't it? It gets through to the mainstream.
Yeah, and certainly, look, I mean, it's something, the personal wealth as well. I was talking about Jensen Huang, they're 21st now in the Bloomberg Rich list. Rich girl, by the way, if you're feeling ambitious for this Friday morning and feel like want to check that out.
Yeah, if you want to make those comparisons, Rich Go is the function to do that. Let's talk about Standard Chartered. We have numbers out there unveiling a $1 billion buyback as it outlined efforts to improve returns. CEO Bill Winters has been looking for ways to galvanise the stock, which has sunk more than 20% in the past year. He spoke to Bloomberg this morning.
We're not happy with the share price at all. And I think we ask ourselves the question all the time, why? Why does the market not recognize what we see in terms of the value of this business? And I think part of that is that there is a sense that it's hard to get things done in Standard Chartered. And this Fit for Growth program is going to tackle that head on. There's a sense that our cost base is high relative to our income. Now, obviously, there's two ways to deal with that. One is to get the income up, which we've done quite successfully. We'll continue to do that. And the other is to make sure that the cost grows slower. I think we've seen now several quarters of stability, but that's with a consistent level of stimulus that has just kept it from falling. So, look, we've got 88% coverage on our at-risk Chinese commercial real estate portfolio, right? So, I mean, we've written it off. I hope we get some recoveries one day, but I think it's going to be a long recovery, just as a practical matter. We were way ahead of the market in taking those provisions, as we were way ahead of the market in taking other provisions related to other businesses that have been impaired. We also set the target 2 years ago of doubling our profits in China over 3 years. We've almost done it in 2, doubling the profits. Now, the juxtaposition of China's having a tough time with we doubled our profits, that's a pretty good outcome. And it's a good outcome because we're generating good, strong top-line growth because we connect China to the world and the world to China. That's what we do, and those connections are stronger than ever.
Are there major impairments coming through from the China exposure for Standard Chartered?
No. We took virtually no exposure, no impairments on our China real estate in the fourth quarter. We did in earlier quarters. We've also taken impairments in earlier quarters on our stake in Bohai Bank, which we took a relatively small impairment in the fourth quarter. This is a kind of a mechanical calculation, value in use. We're properly provided.
Commercial real estate, of course, in focus as well in the West, in Europe, in the US. Do you see opportunities there, given the valuation drops?
Yeah, there could be. I mean, we're not going to be heroes in the commercial real estate market, but we're relatively underweight commercial real estate. We're relatively underweight leveraged finance, two areas that have been hit quite hard on the back of higher interest rates. Will there be opportunities for us to improve the quality of our franchise using our balance sheet in a prudent way, getting some of that asset growth that actually has been a bit elusive for us, getting that back in through some of the areas where our prudence has kept us out of harm's way? That's why we have such low loan impairments. Yeah, there's great opportunity.
It's starting to look attractive to you now. Commercial real estate.
Look, I'm not calling the bottom of any of that. I've also been in the higher for longer rate category, right? And I'm no pundit when it comes to interest rates, but it has felt to me that the U.S. job market is particularly strong. Wage growth is strong. That means higher for longer, and obviously that's what the market is saying now.
Bill Winters, the Standard Chartered CEO, speaking to our colleague Tom McKenzie. The stock popping then this morning, just as it did in Hong Kong, so we got a sort of, prelude into this. 88% coverage on their at-risk China real estate. So even if you're worried about China and the real estate story there and their exposure to it, that's been long documented, hasn't it? That's not a new risk. And they're saying they've written a lot of it down.
They have written a lot of it down, but he's still flagging the fact that it could get worse. So I don't think we have enough visibility yet to really understand what that risk looks like. They got really dinged up in the third quarter. They came out with that big surprise. It was a bit like HSBC this quarter, come out with a big write-down on one of their partners, their bank partners in China. They have taken impairments on that holding. Commercial property is a big risk.
And look, Bill Winters saying it's a long recovery in China as well.
Exactly.
We heard him there not willing to call a bottom on the Chinese economic downturn now, but saying that, they are doubling their profits in China, or they have. So they're, looking at a move in their business being sensitive, but they're looking at the long-term trajectory not being great. I should point out as well, Bill Winters says he wasn't happy with the share price. I wonder if
it's not. Well, it's going to be a little bit happier. It's off a lower base. The stock got really hit in the third quarter. But are these the kinds? If we do see a turnaround in China, how do you play it? I think is a question that a lot of people are asking themselves at the moment. Do you pile back into Chinese equities directly, or do you look for the proxies? And Standard Chartered would be one of those proxies, maybe, if we start to see evidence that the Chinese economy is turning, that maybe you would look for first.
Yeah, you mentioned the fact that this was a bit of a, well, that surprises is one thing we've seen this week not pay off. And that certainly was the HSBC story. I was just looking at where we stand, you know, over the last 4 or 5 days on the banking sector. Barclays up really strongly, up 11% over the last 5 days, and we got a buyback there. Standard Chartered, there was a buyback there. That's up more than 7% over 5 days. HSBC down 6.7%.
Yep.
Even if you're returning money to shareholders, if you surprise them with things they weren't expecting, and that seems to have been a bit of a surprise.
Absolutely. You look at Lloyds. Lloyds is another kind of case in the banking sector where there's things we don't know. We don't know how big this car issue is going to be, this car finance issue. We're going to wait until later on this year. They've taken some provisioning, but we still don't know how bad ultimately it's going to be. So the market marks it down, understandably, on the back of that.
Well, let's get more now from our finance reporter, Will Shaw, who joins us with more on this story. Will, let's start then with the Standard Chartered results. We're talking through some of the headlines from it there. What's your reading on them?
Yeah, so the Standard Chartered obviously has beaten estimates. Adjusted pre-tax profit rose 63% to £1.06 billion. And we know there's going to be a fresh £1 billion share buyback. Obviously, there's been a lot of concern of late about the share price at Standard Chartered, and the stock has sunk 20% over the past year alone. The CEO, Bill Winters, is acutely aware of this. He's been saying, he's been talking about the underperformance of the share price and saying that doesn't reflect the progress that we're making. I think people will be probably impressed to some degree by these results. They'll also be looking forward to hearing about the potential restructure that Bloomberg has been reporting on in previous weeks. And that could separate the investment bank from the commercial and the corporate bank. There's a possibility of job cuts, grim for some, but it could help increase the share price.
Looking at the winners that we've seen this week, I was just pulling up that chart, some data on the Bloomberg that shows me how the banking stocks have performed, Will. And, I mean, the story behind the biggest winners, is it all about returning cash to shareholders? What's been the secret sauce?
I think, well, sort of the standout top performer this week has been Barclays. Talking about restructuring, they set out their first sort of longer-term strategic plan since, I think, 2016. Shareholders basically liked that. They liked the sense that there was a bit of vision there, a bit of long-term planning. The bank's going to reorganise, return at least £10 billion to shareholders. There was a little bit of scepticism among investors about whether or not Barclays would be able to achieve these things, but ultimately it gave them a big boost in their share price, which was just what they needed.
What hasn't worked this week? What has been the secret sauce on the downside?
I think for like the sort of must-try harder category is obviously going to be HSBC. Their Q4 profits fell a whopping 80%. We found out earlier this week. Now, Noel Quinn was on this programme a couple of days ago. He was saying, you know, don't focus on that. That's just noise. But basically, what had taken people off guard was an unexpected $3 billion charge in relation to the firm's holdings in a Chinese bank, which investors simply hadn't seen coming. I should say, like, Noel Quinn depicts this as an accounting error, not an accounting error, an accounting issue, a technical accounting issue, and that it doesn't reflect on the future performance of the firm. But like on the day, investors got a nasty surprise, and it showed up in the bank's share price.
Will, we also heard, speaking of unpleasant surprises, from Lloyds and what they're provisioning in terms of the FCA's review into car financing. Is that number a guess for now? Could that be something that could be more unpleasant as time goes on?
So there's been a bit of worry about how the banks are going to be affected by this review by the FCA into historic motor pricing, essentially. We got some clarity on that this week. We've got a specific number for Lloyds. That's £450 million. Now, in a slightly chilling note for investors, Lloyds also noted that that's effectively not a set number and it could go higher. That's being put aside for compensation and related costs. Now, by way of context, banks like Lloyds and Barclays made a lot of money in recent years selling financing for cars. The good times are essentially over, and the FCA has got some awkward questions it would like to ask. In particular, the regulator wants to know what consumers knew about the commissions that were being paid to dealerships. Now, for the moment, it's capped at £450 million, the provision being put aside at Lloyd's. We've spoken to various analysts, and they think that the maximum bill that banks could be hit with might go as much as £10 billion. So I think at Lloyd's, they'll be very much hoping that the issue remains contained.
Well, thank you very much indeed. Greatly appreciate it. Will Shaw joining us on what a week it has been for the banking sector. Some secret sauce, some not so secret sauce. Okay, let's check in on the individual stocks. There's a few of them we need to be focusing on this morning. Joe Easton's got all the details.
Start with the German earnings. There's plenty of them out today, and one that stood out to me is Allianz. Now, strength in the asset management business, strength in PIMCO, the bond company as well. But I've just read Deutsche Bank's note, and they are saying that property and casualty insurance is weak in this reporting season, and that is why the stock might be falling 2% today. Then we got BASF in the chemical space, potentially finally a bottoming out of some of their revenue targets. According to analysts today, that stock has slumped following a number of profit warnings for the chemical sectors. Are coming up a bit today, but Deutsche Telekom coming down. Competition in US mobile phone markets. They own T-Mobile US, and that is a weight on that stock this morning. Then we've got Hensoldt down the bottom. This is a defence supplier. They make sensors that go to defence companies. Now, they recently did a capital raise. Earnings today expected to reassure investors. That has not happened, and that stock falling yet again. It's had a very bad month for that stock. In terms of other German companies, away from earnings, we're also looking at Deutsche Lufthansa, the surprise exit of the company's CFO after market yesterday, making Lufthansa one of the worst performing stocks on the Stock 600 market this morning. Citi saying that this exit puts the company's margin targets in question, and that should be taken very negatively, according to them. One firm we don't look at too much, Meyer Burger, this is in solar panels, confirming they will do a capital raise. That was the big fear for that market. Big debt problems there. That's over in Switzerland, coming down 19%. Absolutely hammered this morning. And in the car space, an update from Volvo on the disposal of some of their shares in an EV maker. That's coming out just a few moments ago. And Volvo taking a hit in Stockholm, down around 4% for that one at the moment. You've done Stand Chart enough, I think, but that one gaining even more now. I didn't expect it to be as much as that, 6.5%. It was only up around 3% in Hong Kong, so extending the move higher there. And speaking of banks, Berenberg turning negative today on the French lenders. They downgrade Crédit Agricole to sell following weakness in the fixed income business over at the firm listed in Paris. So that one coming down around 0.9%. And to finish off, we go back to Germany because Mercedes-Benz has an upgrade. This one is over at Barclays following that big buyback that we saw yesterday, and that one rising 0.8% this morning.
Thanks so much. Thanks, Joe. Joe from our equities team with the latest on the movers. BASF is an interesting one to pick up on, and also to sort of nod towards the Meyer Burger story that Joe was talking about there, which is down like 14%. We'll get back to that in a moment. But on BASF, interesting to see this one going higher then, popping 2.9% today, even though the numbers missed estimates. Some of the analysts talking about signs of volumes troughing, and this is something that, as the German finance minister I see on my Bloomberg terminal is just speaking, is would be welcome.
So if you look at what is happening with the manufacturing story, it's starting to pick up. You're seeing that in the US ISMs. You're seeing it less so maybe here in Europe. The German manufacturing number was pretty terrible yesterday. Maybe China's starting to pick up as well. But here is a company that's just emblematic of all the problems that Germany faces right now. Heavily exposed to feedstock out of Russia. That gas story has gone away. The energy theme is massive for this company out of Ludwigshafen. They're building a huge plant in China, so the China exposure is getting greater, not smaller. This is kind of Germany at a corporate level and where the problems lie.
This is a good news China, bad news Germany story. I mean, they're saying that they uplifted their growth forecast because of their expecting growth in China. Yep. So that's down to that expansion you're talking about. But the cost cutting then, €1 billion in cost cutting affecting Germany, unspecified jobs being cut there too. Yep. So we're seeing the seesaw work in both directions.
Really interesting just to leap over to Switzerland where Meyer Burger is listed. But this is a story about Germany as well, and it's really interesting. It ties in with all these global themes around investment in renewables. This is a Swiss solar panel maker weaker. They're preparing to shut down one of Europe's largest production sites of this stuff. And instead, guess what? Where are they expanding? They're financing the completion of their Colorado and Arizona manufacturing facilities.
IRA.
Yes, exactly.
This is
one of the global themes we've been talking about with investors for so long.
The US has an industrial policy. Europe is struggling with one.
Well, they have a lot of money behind the one that they have. So there is a question of getting the money rolled out, I think, is where the issue is. The renewable power, this is part of the challenge that's affecting these industries as well. Look at what's happening with older wind farms. The questions about whether or not they're going to have to be closed because that technology isn't as productive, but they're in the best sites for wind power because they were the first ones built.
Where it's windy.
Yes, exactly. So, but
not too windy. Not too windy.
You unplug a whole amount of capacity to be able to take down these old farms. Then you have to reinvest, rebuild the new ones. But in the meantime, you're left with another shortage in supply.
Okay, nice. Little detour into renewable energy we weren't expecting this morning, courtesy of Mayor Berger. We thank them for that. Coming up on the programme, traders reduced bets on ECB rate cuts this year to less than 1 percentage point. We'll get more from our interview with the Governing Council member, Robert Holtzman. We'll bring you some highlights of that. We'll look ahead to the European inflation data. That's due out next week. We'll also get a glimpse, I think, at the top of the next hour of the German economy. Get data out there as well. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Could face bigger challenges next.
What is going to keep Green World Cup? This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
And to do it faster, I suppose. The interesting distinction he drew between him and his colleagues was, one thing was around geopolitical risk. He seemed to be more alert to those risks around, what that might do to inflation, but also the northern European countries' experience of wages. He was suggesting that that was a sort of dividing factor.
Yeah, probably much more important for the council as a whole is wages. That's something that we've seen emphasized increasingly. If you just count the number of times Lagarde has said wage in the last 3 press conferences, it went from kind of under 10 to teens to kind of in 30s or something.
Feels
like
like you've
that.
got a chart of that somewhere, David. Next time, we'll get that.
I do.
One.
I've looked up the numbers, and they're talking about wages a lot. And essentially, right now, the timing of the first cut has been linked to wages. The ECB has kind of moved the goalpost a bit. First it was headline inflation, then it was core inflation, then it was service inflation, now it's wages. So wages are the big focus, and of course that's putting the various time series that are published on wages, everything from compensation that's published in the national accounts to other measures on wage negotiations and other wage trackers that are out there, and people are really looking at that right now to determine whether in the first quarter of the data we don't have yet, when people's kind of pay demands normally are most frequent, whether that shows some easing of the pressure that we've seen recently.
What are the data telling us on either side of the Atlantic about who goes first? We had the PMI data out of the Eurozone yesterday. Germany looks particularly weak. If you look at the ISM data out of the States, you're starting to see manufacturing turning around, coming out of the trough, maybe picking up a little bit. Holtzman's talking about the fact that he doesn't see a chance that the ECB goes before the Fed, but is that what the data is maybe telling us, that maybe the ECB may have a requirement to go before the Fed? The Fed's sounding much more hawkish.
Well, in Bloomberg Economics, our core scenario is that the Fed goes in May and the ECB goes in June, and that chimes pretty much with what's priced in the market as well. And that kind of makes sense. The Fed has taken the lead throughout this period of monetary tightening, and potentially will take the lead in the loosening, and other central banks have been following that to some extent. There's a fair amount of groupthink in central banking. However, the big distinction is that the Fed could decide that if the economy is too strong, if there's not enough signs of weakening, that they're not going to cut. We've kind of already seen expectations dashed for a cut in March, and the chairman of the Federal Reserve essentially acknowledging that's no longer going to happen, and that could happen again. The U.S. economy is much, much stronger than either the Euro area or the UK. And that creates the possibility of them waiting.
Yeah, absolutely. I spoke to a CEO with exposure to the US consumer yesterday, was saying it just doesn't feel like an economy on the verge of rate cuts. So that's sort of one anecdotal piece of evidence. David, thanks so much for joining us. David Powell, Senior Euro Area Economist for Bloomberg Economics. Thank you for joining us. Don't miss our interview with the Bundesbank President. That is coming up. Joachim Nagel joins us 1:30 p.m. UK time. We'll continue those conversations about the North versus the South in the Eurozone as well, part of the narrative. Also, the wages story no doubt will crop up once again. This is Bloomberg.
there is no digital without chips. And I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Markets Today. We're 30 minutes into the European trading day. European equity markets then really not going anywhere, which we will forgive them for perhaps today, because yesterday they certainly did go places. To the moon, as Guy kept saying. Well, we went physically to the moon.
We landed on the moon.
Yes, a private business landed on the moon for the first time.
It's just really the first time in 51 years. I think we should just take a moment. That's a very cool thing to have happened.
It is, but if you did it 51 years ago, does that make it slightly less
It was harder. It was harder then, but it's obviously quite hard to do now. The fact
Sequels
that it's
are tough, you know?
Yeah.
And never quite as good the second time round.
And it landed the right way up, which apparently is not always the case. Sometimes the last one, the Japanese one, it landed upside down.
Yeah,
couldn't do all the experiments.
I'm just impressed that it wasn't Elon Musk either.
No, I know. Other people are playing
Other people can do space.
Okay, so whilst we play you some pictures of landing on the moon, we will talk about stocks doing very well. This was all the Nvidia effect, of course, yesterday, taking out records all around the world. Nvidia itself just was up 16%, added $277 billion in market cap, which was a one-day record, the best one-day performance for any stock. We're not seeing that today. That is yesterday's story, but we thought we'd linger on it because it was so fun.
Well, exactly. I mean, if you're looking for something to be excited about today, Standard Chartered is about as close as you're going to get. The second best performing stock in the stock 600, up by 6.6% at the moment. That, you know, a story around where the outlook goes from here. The announcements of another buyback, $1 billion from Standard Chartered helping as well.
Let's talk a little about some of the stocks that have been on the move this morning, because that will help us sort of segue into what we're doing next on the programme. BASF is one of those, and actually the stock has been doing quite well. And chemicals, now the best performing sector on the stock 600. BASF is not up that much, it's up 0.7%, but it's interesting, it bounces even though it disappoints.
In my previous job, I used to talk to Tim Furry, who runs the manufacturing survey at the ISM, and chemicals are his big tell. So if you talk to him about kind of what's happening in the economy, he's like, keep an eye on what's happening with the chemical sector. It's the kind of the precursor for everything. It's the building block for absolutely everything. If chemicals are starting to turn around, you can read that's kind of early stage macro turnaround narrative. And he started talking about it a little while ago. And hey, presto.
Yeah, and if some of the analysts are talking this morning about seeing a bottoming out of that weak volume story in the fourth quarter, then that, to Guy's point, is important.
And growth in China. What an interesting early signal that is, if that's coming from, you know, when we're looking ahead to an economic conference in China coming up too, it's going to set policy, and that's going to put us in another direction too.
Okay, economics never far from geopolitics, so let's go there next. The US is set to impose new sanctions on more than 500 people and entities linked to Vladimir Putin's war machine in a bid to squeeze the Russian economy. Bloomberg's Samuel Etienne gives us an update on what's changed in Ukraine since the invasion.
2 years on since Russia launched its widespread invasion of Ukraine, the UN has recorded over 6.3 million refugees, with over 3.7 million people internally displaced. But there hasn't been much movement in terms of territory gained and lost. The land operation has not delivered long-term success, in contrast to naval efforts in the Black Sea, where Kiev has managed to unlock part of the sea route for exports. Now, in a bid to turn the tide of war, Ukraine has changed its commander-in-chief, President Zelensky selecting Oleksandr Syrsky, the former head of the ground troops there, to lead the armed forces. And military aid continues to flow into the country, with the US committing over $44 billion, dwarfing the UK and EU figures. But changing attitudes to support for Ukraine is a key risk for the next 12 months. In a US election year, former President Donald Trump and Republican Party members are questioning just how much longer the US can continue to support Ukraine financially. All of this as Russia has become emboldened and re-intensified its campaign in the east of the country.
Samuel Etienne there. Joining us now, Fenella McGurty, Senior Fellow for Defence Economics at the International Institute for Strategic Studies. Fenella, thank you for giving us your time this morning. It's interesting that a lot of conversations about who's going to lead NATO next, and this in the context of, as Samuel was telling us there, the forthcoming US election. Mark Rutte, who might get that job, warning members of NATO, stop complaining about the possibility of President Trump coming back in the United States and spend more on defence. That increasingly seems to be a shared view.
Absolutely, and I think what we are seeing in among NATO members has been a protracted increase, certainly in the last 2 years. It's been quite pivotal. And last year, global defence spending grew by 9% to reach $2.2 trillion, and a lot of that growth was driven by European NATO members. So what you have in Europe is this shift in 2014 following Russia's annexation of Crimea, and then that pivotal shift again in 2022. So NATO members are increasing spending. We're seeing it increase as a proportion of GDP as well.
It seems through the conflict in Ukraine, Russia's war in Ukraine, defence experts are going to be learning a lot about, crucially, the pace of use of defence supplies and the time it takes to produce them. How does Europe sit with that in mind? Because that seems to be something that those in the defence sector are talking about a lot, Europe's ability to actually produce fast enough.
Yeah, I think with the uptick in demand, defence industry is now kind of trying to respond to that. That surge was primarily driven by governments, needing to provide military support to Ukraine and backfill inventory, and that exposed some gaps in arms production. So demand isn't the problem; it's meeting it that's now the challenge. It's quite a fast pace, and it's fairly difficult to increase production at that pace. We had years of efficiency savings among European defence industry, so it's quite lean management. There wasn't much stockpiling. Yeah. So when it came to rapid increases in production, it was inhibited now again by supply chain challenges and recruitment difficulties. So all of these things kind of come together, and we're seeing a few initiatives, both privately and publicly, to try and alleviate that pressure.
Fenella, good morning. It's Guy. The CEO of British BAE Systems was talking about this the other day. He said it's fairly easy to double the throughput in a factory, but if you want to go further than that, you're looking at 2-3 year lead times. He talks about the fact that it's hard to restart cold plants. They've just restarted their howitzer plants, I think. Are we looking at a period where we are going to see permanently higher defence spending in order to maintain this capacity? Are we going into a new period for that? Defence stocks have already rallied quite significantly. Is this a permanent feature of the landscape now?
I think another key thing that came through last year was that European countries are coming up with longer-term plans for committing to defence as well. So it's not... it doesn't seem to be a one-off surge in Europe at the moment. There seems to be this commitment from governments towards industry to say there will be this demand. You can invest with confidence, because obviously the capital costs are huge when you're trying to ramp up production, and it's quite a risk for industry to take. So it's finding out that it's determining when that demand might shift as well. Because obviously before this happened, the shift or the trend within defence industry, industrial development and investment trends, R&D, it was all sort of towards emerging and disruptive technologies. And obviously with this war, it's back to conventional arms munitions. So it's a sort of direct shift in trajectory. So now determining when that is going to continue till and what the shift might be. So I think governments are trying to reassure industry as much as they can.
2% seems to be the magic number. Does it stay the magic number? If Donald Trump were to return to the White House, do you think he would could force through a higher number? Does Europe potentially have to spend more than simply 2%? Getting to 2% feels like it's hard, but in reality, is that just a stopover on a much longer journey to significantly higher defence spending?
I don't think that's an unrealistic point. I think that could be something that comes through. Certainly the pressure and the pace with which it's taken to get to 2%, has taken over about a 10-year period, and some countries aren't quite there yet either. They're still around 1%. But I think the pressure has always been there. It's really whether these governments can afford to do so as well. The reason that we did have those shifts over the last 10 years was because it was enabled by an improvement in underlying economic conditions, as well as that shift in strategic or security drivers as well. So the political pressure has always been there, but countries can only really do as much as they can within the fiscal boundaries that they have. So until you have all of those three pillars aligned, it will be kind of increasingly difficult for these countries to get beyond that 2%, given how difficult it has been to get there now.
One of the workarounds that's being looked at in Europe is getting the European Investment Bank involved in this, and this is something that's being discussed by European finance ministers meeting in Ghent this morning. Germany's Christian Lindner saying that Germany supports EIB co-financing of defence spending. Is that the solution for Europe? Is it more mutualisation of spending, allowing joint debt issuance that will provide that both help in funding, solve a problem for the governments, but provide confidence to the defence industry?
I mean, it's a two-edged sword in that way, because what you'd ideally have is the core defence budget would see sustained growth, there would be longer-term planning, and there would be that security of growth for defence industries to look to. Other instruments, you don't necessarily have that security with. So, for instance, we're seeing countries like Germany, Japan, Poland implement off-budget or extra budgetary funds for defence as well. And that raises sort of issues with transparency and security of funding as well. I mean, it's something that had to, I think, be implemented in order to increase spending so fast, because it can take a lot longer for core spending, for core budgets, to see that growth. So these instruments were rather necessary in order to achieve these to meet these production challenges, to increase investment in defence. But ultimately, I think countries will need to work on the bottom line to try and instill increases in the core defence budget in order to ensure that security to defence industry.
So how wary are defence companies then of these off-budget funding for defence? I mean, you know, the German defence minister said they could ramp up military spending to 3.5%. They've had a huge off-budget spend on this as well. Is this something that the industry is very wary of?
Well, I think it can provide sort of immediate opportunities, but when you think of the defence industry, the lead times are so long that the investment that you make now, you might not see any sort of production for 10 years until 10 years time. So you need that longer term security. I think industry welcomes the extra funding, and it may help with the challenges that they're seeing immediately in terms of inflation and supply chain issues and the support that they need now. In order to invest for the future, but I think security of funding over the longer term, in terms of building it into core kind of manifestos and budgetary planning, would definitely be beneficial as well.
Okay, even more interesting, something to monitor as we move into election season for the European elections, of course, coming up in June as well. Fenella McGarity, Senior Fellow for Defence Economics at the IISS. Thank you very much for joining us. Now, coming up, it's Nikki Haley's home state, but tomorrow's South Carolina Republican primary is not going to be a walk in the park for the former governor. That story next. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. You're watching Markets Today. Equity markets are kind of drifting sideways. You're seeing a little bit of bond market selling this morning as well. Basically, we're all kind of dealing with yesterday and kind of coming to terms with what happened with NVIDIA. So I think we can all just relax today, take it easy, see what happens next. Talking of what happens next, Nikki Haley has vowed to stay in the Republican race regardless of the outcome of tomorrow's South Carolina primary. Polls suggest the winner will be, yes, you guessed it, Donald Trump, who has swept every nominating contest thus far. There haven't been many. There are many more to come. Obviously, Super Tuesday will be with us very, very soon. Lindsay Newman, who is the practice head of Global Macro Geopolitics at the Eurasia Group, joins us now. Lindsay, good morning. We're looking forward to seeing what happens this weekend. Nikki Haley delivered a speech earlier on this week. She said, if you guys think that I'm here to give this speech to basically pull out of this race, think again. I'm going to stick with it. If she loses in South Carolina, will that continue? How much longer can she stay in the race? And what are her options?
Thanks for having me on, Guy. You know, absolutely, as you say, the polling is clear. At the national aggregate level, Donald Trump leads her by 60-plus points. And in her home state of South Carolina, that number is 25 and upwards. So it's not about the race. That's all but clear that Donald Trump will be, at this point, very clearly looks like the Republican nominee. So, as you say, why is she staying in? Why is she willing to stay in and intend to stay in, not just through South Carolina, but through March 5th and Super Tuesday? And there are a couple of factors that we're thinking about here. The first is that so long as it's financially viable for her to carry on, she will, because that will put her in a position to have the second most delegates should any of, and let me be very clear here, any of the tail risks around Donald Trump, like around his legal constraints, come to bite, and then she will be potentially the front runner for the Republican nominee. Again, very clearly, those are tail risks. We very much expect Donald Trump to secure that nominee. And the second point here is Nikki Haley is from a younger generation. She was very successful in her campaigns before the Trump period. And so she's seeing 2024 is not the end. This is not the finish line of this race. So she's still looking for the future and for success post 2024. But I should just say this is all very in line with Eurasia Group's top risk, their #1 risk for 2024 of the U.S. versus itself. And it's creating a great deal of anxiety for those watching from abroad.
Yep. Lindsay, this is kind of come back to the options. I hear what you're saying about kind of America versus itself. At the moment, it's kind of Trump versus Biden, potentially. Nobody really wants that as a contest. Nobody really wants that showdown. Could Haley be a third-party candidate? And if she were to be a third-party candidate, a no-name candidate, how many votes do you think the middle could take?
Look, third-party candidates have not historically gained a lot of traction. I mean, you have to look back quite a few decades in order to see really where that has played any sort of spoiler role in an election. Nikki Haley has been a longtime Republican. She's had success as a Republican in South Carolina. She's represented the party internationally on the foreign stage as UN ambassador. We really think that this is about putting herself in a position that should there be any constraints, any tail risks around Donald Trump, she's continuing to be in that conversation. And, it's important to remember, she's saying very clearly, this is not about a VP role. This is not about a role in the administration. And in fact, we're here, we've seen reports that she's not been shortlisted for VP. So it is about how she can position herself within the Republican Party for 2024 and then beyond.
Thinking still about 2024, Lindsay, good morning. You mentioned former President Trump and his likelihood to be the nominee there. What is your assessment of his legal battles and the extent to which they do or do not have bearing here?
Former President Trump has a number of legal challenges at the state and federal level ahead of him. Some of them we think are more potentially constraining than others. The big headline here is he's going to be dealing with this throughout the campaign trail, and he's already started to show how that's going to work. He's going to be going to court during the day, and he's going to be having campaign events in the evening. But this is not slowing down his popularity. As I said, he leads Nikki Haley by 60 points in the Republican nomination. And right now we continue, to see him as the overwhelming position to take the Republican nominee. And, then it becomes a question of where do we get to in the race with Biden? And our current view, our baseline view right now is it's very close, 55 to 45 in Biden's favor. But there's a long race, as you say, ahead of us.
I think there's a delegation of U.S. senators on their way to Ukraine, in fact, right now, Lindsay, or over the weekend. Link these two themes for us, because clearly Ukraine has found itself in the middle of a U.S. political story. I know that Schumer has been saying, of course, a New York Democrat, saying that America is not abandoning Ukraine, but for many in Ukraine, it might feel that way. What is going to be the role of this story in the U.S. political debate?
It's as you say, the Europe and the world are watching to see whether there's going to be another change in U.S. leadership. And that's a question of whether there's policy continuity in the U.S. Then they're particularly looking to see, is that change going to involve a second Donald Trump administration? And with that comes all of the rhetoric that we saw during Trump 1 around the transatlantic relationship and U.S.'s commitment to NATO and Europe's commitment to NATO. And this time around, what the concern is and what we're watching for is whether that rhetoric that we saw, and we've already seen on the campaign trail, calling for European nations to pay their fair dues and potentially raising the prospect that the U.S. could pull out of NATO, whether that rhetoric is actually this time around going to be backed up with action. And the worst case scenario for Europe, of course, and the worry is that the U.S. will come out of NATO, that degrades Article 5. That is not our baseline view. Our view is that there's going to be a transactional nature of the relationship here under a Trump 2.0, where Trump and the administration will be looking to deal bilaterally with European NATO allies, as it has in the trade space during Trump 1.0. In the national security and the security and defense space, it will be looking to deal transactionally and bilaterally with NATO partners. And so those countries that are paying their dues and are at that 2% or higher level are going to see more engagement, and those countries where there are larger funding gaps are under Trump 2.0. We expect to see that there would be further constraints on that relationship, and that could involve pullbacks pullbacks from military exercises, pullbacks of troop levels. Again, not for the sort of long-standing, ongoing resources in Europe, but for those related to those NATO members that aren't paying their fair due. We expect to see that under a Trump 2.0.
In the anticipation of that, or the possibility of that, Lindsay, is that why we're not seeing global forums like the G20 coming up with concrete solutions or progress, you know, words about supporting Ukraine, but disagreement about the language to be used there as well? Are those forums now even more relevant with the possibility of a second Trump presidency?
It's a really interesting point, because we're at this moment right now where we have foreign ministers meeting in Brazil. We're seeing the kickoff of Brazil's G20 presidency. The intention there was to be around a just and sustainable future. That's the tagline for the G20 presidency. And what we're really seeing is a couple of things. First of all, we've already touched on them this morning. The world is in disorder and disarray. Secondly, there's disagreement about how to deal with these issues, from Russia, Ukraine to Gaza and Israel. And then there's this effort that Brazil is putting forward to focus in on how do we reform our governance gaps? How do we reform the UN in particular and the UN Security Council? This is really interesting because it's showing how the Global South is trying to engage and hold relevance and contribute to the conversation. But historically, multilateral reforms, UN reforms, the UN Security Council, that's not low-hanging fruit. So really, it's what to watch here is how are these engagements indicative of progress that's going to be made on Ukraine payments and on negotiations in Israel-Gaza.
Lindsay, great to get your coverage. Thank you very much indeed for setting us up for what's going to be an interesting weekend as well. Lindsay Newman joining us from the Eurasia Group. There's going to be some great coverage coming up. Kayleigh Lyons, the rest of the team on Balance of Power, will walk you through this weekend and the implications of what happens in South Carolina. So look forward to that coverage over the next 24, 48 hours.
Shall we just quickly check on the markets as we bring this hour to a close? We're not really moving very far at the overall macro level. Yesterday was enough. Everybody, you know, it was a real incredible rally on the back of the Nvidia. This is the hangover, exactly. This
feels like a nice hangover.
Yeah, there we go. Doesn't come with the headache, perhaps, unless you were on the wrong side of that Nvidia trade. You have our sympathy. But this is where we are on a number of key stocks. We're up on Standard Chartered, really quite strongly. Buybacks and beating estimates paying off there. Volvo in the mix as well. Volvo Cars down 4.2%. The Polestar stake, part of the conversation there. Lufthansa also on the back foot.
CFO on the way out. Yeah. So changing the management board, they're going to be reducing the management board at Lufthansa, but the market is not liking that, concerned about targets maybe.
Okay. No, absolutely. I was just going to say, let's just flag that coming up, we have the iPhone numbers out of Germany. Yep. We talk quite a lot about Germany. We'll put up the graphic that shows you what's coming up in your day ahead, but really what you need to know is the German iPhone and a number of ECB speakers. I think those are the highlights that stood out to me last time we checked on this.
That's what's coming up the rest of the day. This weekend, England versus Scotland, Murrayfield, that's going to be the key main event that you need to be watching out for. I'm a little nervous, I have to say.
Maybe we'll have to introduce on a Friday what to watch over the weekend, sporting events.
Yeah, Finn Russell's quite good.
We'll leave that to Guy, though.
A culture? Sure. Yeah.
Culture. We can do culture. I'm happy to do culture.
Okay.
Excellent.
We can do both.
We'll introduce that next time Stephen's on the programme. We will allow him to bring his cultural bent to the programme. We will be speaking to President Clemens Voigt about the German economies. That iPhone conversation will be coming up shortly for you. We've talked a lot about Germany here, haven't we? We talked about the weakness, and there may be signs of green shoots if you can take a pop in the BASF share price that far.
Well, I think just turned positive, actually, so there you go.
Yeah.
Has it?
Yeah.
Green shoots in Germany. There you go. Have a great weekend, everybody. Thanks for watching the show. We'll be back. We'll do it all again next week. Stephen, thank you very much indeed.
Thanks for having me.
Really fantastic to have you along for the ride. The Pulse is coming up next. Have a great weekend. Some great sport coming up this weekend. Liverpool-Chelsea as well. You don't want to miss that. This is Bloomberg.
much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Global equities hit records as NVIDIA surges to an all-time high with the biggest one-day increase in market value in history. Hong Kong and China bucked the trend. Standard Chartered is one of the top gainers on the Euro Stoxx 600 after the bank topped expectations and unveiled a $1 billion share buyback. Plus, China's home prices decline at a slower pace, a first sign of improvement in 10 months. We discuss what it means for the country's outlook with BlackRock's global chief investment strategist, Wei Li. Now, first thing is first, let's check on the European markets map. Again, we did see a couple of pauses, I would suggest, after that record-busting rally from the U.S. and also Japan. They all hit all-time highs in the wake of NVIDIA's blockbuster earnings. Now, if you look at what's happening in today's trading session in Europe, little change. U.S. futures also a little changed. Because there was so much, I guess, artificial intelligence mania, and NVIDIA did so well, the most valuable chip maker, maybe a lot of that good news was priced in yesterday. Now, the question is whether the tech rally can now be sustained, but also be brought into other sectors, even as the Fed rate cuts seem to be waiting amid data that shows that the U.S. is still going quite strong. Now, we're also getting some IFO figures. This is a good indication, as always, to see what the German economy is doing. Germany being one of the main concerns for Europe at the moment. That German February IFO business confidence coming in pretty much in line with expectations. I don't think it's actually having any impact, given it's in line with expectations, on euro dollar, which is 108.23. Now, for more on Germany, of course, this latest IFO number, let's get straight to Clemens Fuest, the IFO Institute president. Mr. Fuest, thank you so much for joining us. I feel like it's been a couple of months where I ask you, how worried are you? How worried are you? Is this a little bit different because it matched expectations? Do you think we could be bottoming out?
I think it's too early to say we're bottoming out, but this stabilization is certainly a good sign. Nevertheless, if we look at the numbers, this is coming from a slight improvement in expectations for the next 6 months. The current business situation is unchanged, and so I would say it's a stabilization at a low level, and we'll have to see where it's going.
What do you worry about the most in the German economy right now? Is there a worry that this gets entrenched, and so it's very difficult also for the government to put any kind of support to get the economy out of this rut?
There are two areas really where there's reason to worry. One is manufacturing. So we really see a further decline in manufacturing and production. Companies are telling us orders are falling, and this is in particular in the production of investment goods. And it's really domestic markets. That's one area. If companies invest less, this has a longer term impact. We haven't yet reached investment levels of 2019 in the corporate sector overall. So that's a concern. The other concern is the building sector. So building of apartments, of housing, has really collapsed in Germany for a number of reasons: high building costs, high interest rates, and so on. And this is getting worse and worse. So these two areas are really areas of concern, and the government tries to do something about it, but they have difficulty getting their act together. So not much is happening so far.
Mr. Fust, how worried are you about labor productivity growth? I mean, this was one of the big concerns because we saw that loss of momentum. Again, are there any signs of green shoots out there?
Well, labor productivity growth has been slow for some time, and the fact that we see so little corporate investment means that it will probably remain slow. The sectors growing at the moment is not manufacturing, so not the high productivity sector. So for the economy as a whole, we will see low labor productivity growth. That's for sure.
I know the government this week also slashed their own growth forecast for 2024 to just 0.2%. Is there anything that the government at this moment can put in place to try and boost the economy?
So the government is currently trying to put in place some stimulus package, but it's extremely small, just 3 billion. And it has difficulty getting it through the second chamber where the German states are represented. The German states are saying, yes, it's a nice idea, but we don't want to pay for it. The federal government should pay. Now, this package, small as it is now held up by this dispute over money. That's a problem. In any case, even if it passes, it's very small. It will not change things. The government has announced there will be further reforms, but it's not clear where the money is going to come from, and it's not clear whether there will be agreement within the government and then with the states to get this done.
When you look at some of the GDP figures, so the German output was also dragged lower by the lack of investment in the fourth quarter. When does that rebound?
That's very hard to predict. I suppose it may rebound if there is a shift in government policy. It might also rebound if there was stronger demand from abroad, but it's not clear where that should come from. That's why I think the overall forecast the government presented yesterday, stagnation in this year, is realistic, and then maybe next year things will be better, but we really don't know at the moment.
I mean, I guess there are three main ailments, as you correctly point out. There's an aging workforce, there's a lack of investment in, for example, technology, but also infrastructure, and there's also, this excessive bureaucracy. Will that be dealt with? And again, is there a problem of timeline that even if some of, I guess, the hard pills to swallow are put in place, it still takes 12 months, 18 months, if not longer, for that to have an impact?
Correct. These are very important structural reforms. Getting rid of bureaucracy, for instance. But this is not easy because some of that bureaucracy that has been added is linked to European legislation as well, and turning that around is very difficult. So a lot of that can't be done just in Germany, but needs to be done more generally. Among the things we can do domestically, yes, there are some options here. For instance, building regulations, they are very strict in Germany. The planning procedures are very complicated and lengthy. But again, turning that around is a longer process. At least the government has promised to do something about it, but to what extent that can be implemented is difficult. Also here, the federal structure is again important. So the states and the federal government need to work together.
How much relief would a rate cut by the ECB bring the German economy?
It would help. We expect it to come sometime in the summer, and it would certainly help construction. So it would change things at least a little bit. At the same time, the impact, would be maybe felt, but not so large, because something that's holding back construction investment at the moment is uncertainty about future regulations, in particular related to energy-saving climate protection. There was a lot of confusion about the heating regulation in Germany, the regulation for heating for buildings. And a lot of investors are saying now, we don't know what this government will produce in terms of future regulations, so we hold back our investment, and that cannot be addressed through rate cuts.
Thank you so much for your time today. That was, of course, Clement Fuss, the IFO Institute president, on a pretty robust conversation on the way forward for the German economy. Now, NVIDIA rose the most in about 9 months after the chip maker delivered another eye-popping sales forecast, adding fresh momentum to a stock rally that already made it the world's most valuable chip maker. Now, shares of the chip maker jumped 16% on Thursday, adding about $277 billion in market cap, bringing its total market value to about $2 trillion. And you can see pre-market gaining some 2.3%. Now, the other story is Intuitive Machines surging some 71% after the spacecraft landed on the moon. Now, this craft became the first private space vessel to actually land intact on the lunar surface. It marks the first return to the moon since 1972 for the U.S. The mission aims to provide NASA a close-up of the South Pole region and its systems. Coming up, we'll be discussing space, but also the prospects for a rate cut by the ECB as EU finance ministers and other officials meet in Ghent. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
We grew 5 times above the Eurozone average. And this was based on 2 pillars. Of course, the strength of our labor market. 4 out of 10 jobs in the European Union, new jobs in the European Union in 2023 were created in Spain. And it was also the second pillar, of course, the strength of our external sector, even within already somehow some deceleration amongst our main trading partners in the Eurozone. So for this year, we expect still to have growth above our partners.
The cuts will determine by the future, and the prospects now may be ready for 90 points, but I could imagine a number of other scenarios which have not been taken into account. And for me, the main risk it's the geopolitical risk around the Red Sea. This may or still may explode, and if it does, the 19 basis point may be much too high, if at all.
Well, Spain's economy minister and then the Austrian central bank governor, Robert Holtzmann, both speaking to Bloomberg earlier from Ghent, of course, Belgium, at the Eurogroup meeting. Now, don't miss also our interview with the Bundesbank president, Joachim Nagel. That conversation at 1:30 p.m. UK time. So the ECB says inflation expectations in the Eurozone edged higher in January, reinforcing the case for a cautious approach to cutting interest rates, where I'm delighted to be joined for the next 20 minutes by Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Wei, as always, thank you so much for joining us. I mean, first of all, I know we talk about central banks and a lot of the interest rate cuts expectations have been pushed back a little bit, but really everything's dominated by NVIDIA. I mean, how strange is it to have one stock dictate all markets?
While if the theme and the driver of markets is the AI theme, then it's possible that markets are very concentrated around that, and these are the names that is very interesting, and you call it strange, but definitely notable so far this year is that despite the fact that markets are pricing out rate cuts by the ECB, by the Fed, earnings are pushing equity momentum higher. And the way that I kind of bring them together is as we think about evaluating risk assets, you discount future cash flow. So the discount rate is going up, but future cash flow is going up as well. So the denominator is actually having a negative drag on broader sentiment because of the pricing out of rate cuts, but the numerator is outweighing the denominator, which is what we're seeing right now.
But wait, is there danger, and I've heard it from certain corners, that actually if we push back rate cuts, then we're really going to have a problem with the economy? Could that be like a policy mistake?
If we push back rate cuts, I mean, right now markets are pricing in 3 cuts, slightly over 3 cuts by the Fed, by the ECB. We're not talking about rate hikes. I know there are chatters of maybe the next move could be rate hikes, but I think the bar for that is really, really high. So, you know, going from 6 cuts at the beginning of the year to now 3 cuts, that sounds sensible. I wouldn't necessarily say that that would be very alarming unless something dramatic happens with the economy. That's actually what we expect for this year. Now, having said that, there is a nuance that I want to introduce a little bit in terms of the path of inflation trajectory. So right now, markets are very fixated around how difficult it is to get the last mile of inflation down. We actually don't think that that's very hard because goods deflation in the U.S. is running over minus 2%. Actually, we are expecting in the coming months and quarters that in Europe as well as in the U.S., inflation hits target. So when that becomes clear, then maybe markets could reprice again, as they have wildly been repricing, from left to right and right to left very, very quickly in the past 18 months. So repricing could still happen. But where we differ from kind of the inflation going down and staying down is that we think that it could go up afterwards because of structural constraints.
And so, again, what does that mean and how they should deal with it? I mean, the U.S., I'm fascinated by the U.S. economy because also productivity has really shot through the roof. Now, a lot of that seems to be immigration policies, which could change under President Trump. But how do you see the U.S. economy kind of behaving over the next 12 months?
Well, we are seeing a reasonably resilient U.S. economy. Consumers have been strong and continue to hold up. We're expecting slightly below consensus growth for the U.S. economy, avoiding a recession, which is good enough for risk assets. We're also seeing inflation falling to target and then rebounding, but for the foreseeable kind of future, near-term future, we're talking about a combination of growth holding up and inflation falling towards target, and central banks starting to cut. And that's a reasonably good combination for risk assets, which is why, yes, we like AI, we like the tech theme, but we also think that the broader market can be supported by this narrative of immaculate disinflation.
But, so if you're expecting inflation to possibly go up again, would that, so could we see, 2-3 cuts and then possible hikes into next year? or is it just a readjustment in terms of structural?
We think that rates will be cut this year, three times this year. And then next year, as inflation kind of trends higher in response to wage pressure, persistent wage pressure, and structural constraint, we actually see rates getting cut, but not as much as what markets are expecting. So it's just higher for longer being our expectation.
Wait, thank you so much. We have so many more questions, so don't go anywhere. We're there from BlackRock, of course, stays with us. Now, coming up, we'll be discussing China's property sector after more positive data emerged on house prices. That's next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
So Chinese house prices for both new and existing units fell at a slower pace in January. It's the first signs of improvement in 10 months as efforts intensified to combat the property crisis. Now let's bring in Bloomberg's senior China reporter, James Mager, in Beijing. James, thank you for joining us. Does it mean that some of the policies put in place are starting to work?
I don't think that's what this is showing. If you look at the numbers, you look under the hood, yes, the fall slowed for new homes and for second homes, but the total amount of sales in January was the weakest in any month since the start of 2021. And actually more cities saw their prices falling. So 69 cities out of the 70 cities in the survey had seen house prices, secondary house prices falling. Now it's 70, so every city in the survey now has the secondary market. These house prices are falling. New house prices fell in more cities as well. So the drop, the level of the drop seemed to become a little bit shallower, but actually it's becoming more widespread. And I think it looks like it's actually getting worse if you look at the amount of new homes that are actually being sold. So I think the government has brought in a lot of different policies over the last couple of months to try and sort of help the market find a bottom in the housing market. You're seeing cuts in the RRR, you're seeing cuts in the LPR for the five-year LPR, which is the basis for mortgages. You're seeing a lot of cities cutting mortgage rates as well, but so far I don't think they're having the success in actually stopping or turning around the general housing market.
James, thank you so much. So interesting. James Mager there in Beijing. We're also back with Wei Li from BlackRock. Wei, when you look at some of maybe the more targeting easy measures from China, it seems to have worked to support some of market dynamics. Is the way forward better?
Well, have we seen the bazooka that markets needed to really sustainably turn around? Perhaps not, but we do have the 2 sessions coming up, so lots of kind of events that can bring further kind of development. But what I would say is that Chinese equity markets are very, very cheap, and it doesn't take much to rebound a little bit from the 5-year low, which is what we have seen already in recent weeks. But positioning is so negative, and sentiment continues to be so negative, and because of that, actually the pain trade is maybe perhaps for Chinese equities to continue going higher, which is why we are currently neutral. But having said that, as James said as well, that the real estate overhang is still there. The problem is not resolved. And over the longer term, we also continue to have the headwind in terms of aging population and slower structural growth. We're expecting Chinese economy by the end of the decade to grow with a 3 handle. We're talking about that not being notably much better than many developed economies. Right? So when that is the case, yes, we're neutral, but we're not overly excited about the market. Where we see greater opportunity is in likes of Japan, for example, where the decades-long deflationary mindset is finally starting to dislodge, and the next leg higher could be driven by micro news, by earnings momentum, and we see further room to go there.
Way on politics in general. So we have a big weekend coming up in South Carolina. I mean, the focus is so much on the primaries. When do markets start pricing in, the possible change actually of an administration in the U.S.?
Well, typically the rule of thumb is that markets start to react to U.S. elections around summer. But given the very extraordinary nature of the election so far, this year, it's possible that markets can react sooner than that. But I would also say, two things I would say. First is that elections years tend to be good for equity sentiment. You look back the last 100 years, only 4 election years where S&P was down on the year. So election year with greater focus around fiscal spend tends to be good for sentiment. And then the second thing I would say is that instead of trying to kind of bet on the outcome, which is very, very hard, we identify policies that are likely going to happen anyway, what it means for inflation, for growth, and for fiscal.
So smart. Wei, thank you so much, as always, for joining us. Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Coming up, after Standard Chartered topped expectations, we'll hear from the Chief Executive. That's next, and this is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world, And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
This is Bloomberg.
Now, global equities hit records as Nvidia surges to an all-time high with the biggest one-day increase in market value in history, keeps rising in pre-market trading. Hong Kong and China bucked the trend. Standard Chartered is one of the top gainers on the Euro Stoxx 600 after the bank topped expectations and unveiled a $1 billion share buyback. Plus, China's home prices decline at a slower pace, the first sign of improvement in 10 months. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So shares of Standard Chartered surging after the EM-focused lender announced a fresh $1 billion buyback and fourth quarter profit beat estimates. Now, speaking to Bloomberg earlier, the chief executive, Bill Winters, told us he's not happy with the current share price. He also outlined the bank's efforts to improve return and reduce complexity.
We set out the target 2 years ago of returning in excess of $5 billion over 3 years. We've done 5.5 in 2. Okay. So I'd say we far exceeded the initial expectations. Why are we able to buy back that stock? Because we're doing really well in our business, right? We generate profits. We're investing healthily in the business. So we're definitely investing for growth. We've got great top-line growth in our business. We're forecasting continued good, strong top-line growth for the next 3 years. We've got good control of expenses. We've had very low loan impairments. You know what that means? That means we generate equity, which we can invest in the business and then give a chunk back to shareholders. So we've extended our guidance to say, you know, beyond the 5 that we said 2 years ago, we're going to do 5 from here. And that's.
It sounds like you want to be topping that 5. It's the target, but you hope to top it.
You know, if we can outperform the relatively strong guidance that we've given to the market, which we've done in the past, then of course there's more to go. Okay. But we'll also be looking for ways to continue to drive that growth.
Some investors will say, look, we still need that ambition. Price to book, you're trading at 0.4%. The stock is down about 40%. It's up in the session today. It was down about 40% since 2015. That there needs to be a more comprehensive plan to extract value from this business.
Yeah, I mean, it is down. We're not happy with the share price at all. And I think we ask ourselves the question all the time. Why? Well, why does the market not recognize what we see in terms of the value of this business? And I think part of that is that there is a sense that it's hard to get things done in Standard Chartered. And this Fit for Growth program is going to tackle that head on. There's a sense that our cost base is high relative to our income. Now, obviously, there's 2 ways to deal with that. One is to get the income up, which we've done quite successfully. We'll continue to do that. And the other is to make sure that the cost grows slower. So we've guided to positive jaws. So income growth faster than cost growth in each of the next 3 years. That's a key component of our strategy. Of course, we're going to maintain the discipline that's had us generating credit losses and impairments that are much lower than our historical average and lower than our peers, which also gives us capacity to invest now in that business. So
what does it mean for jobs then? Are we going to see the likely kind of headcount cuts that we've seen across some of the other major banks? Is that potentially what is in the cards?
You're going to see a transformation of the bank and the way that we do business. And of course,
so what's about numbers? What about jobs?
No, we'll talk about roles. So there are roles that will disappear. There are clerical jobs or administrative jobs or all that manual stuff.
Hundreds, thousands?
No. Well, but let's get a few numbers on the table. Yeah. Our typical attrition in a typical year is between 10 and 13,000 people per year. That's voluntary attrition. People come, they go. We've got 30,000 people in India. People cycle through Kuala Lumpur, Tianjin, Guangzhou, etc. So that's most of what we would have in terms of transformation. We can handle through natural attrition. The important thing is when we look at transforming that business, we know that there are going to be roles that go away as they're automated. We know that a year, 2 years, 3 years ahead of time. So we start training our people early on. We've got a massive program for reskilling and retraining. And our objective is to have every single person in our bank have a chance to remain in the bank even if their role goes away.
What are you thinking when it comes to China, the focus on the real estate market? You've talked about, you think maybe we've hit the bottom in terms of the pressure coming through for the Chinese real estate market. Do you stick to that line? No, what keeps you relatively confident?
Yeah, I've not called the bottom, just to be clear. I think we've seen now several quarters of stability, but that's with a consistent level of stimulus that has just kept it from falling. So look, we've got 88% coverage on our at-risk Chinese commercial real estate portfolio, right? So, I mean, we've written it off. I hope we get some recoveries one day, but I think it's going to be a long recovery, just as a practical matter. We were way ahead of the market in taking those provisions, as we were way ahead of the market in taking other provisions related to other businesses that have been impaired. We also set the target 2 years ago of doubling our profits in China over 3 years. We've almost done it in 2, doubling the profits. Now, the juxtaposition of China's having a tough time with we doubled our profits, that's a pretty good outcome. And it's a good outcome because we're generating good, strong top-line growth because we connect China to the world and the world to China. That's what we do, and those connections are stronger than ever.
Are there major impairments coming through from the China exposure for Standard Chartered?
No. We took virtually no exposure, no impairments on our China real estate in the fourth quarter. We did in earlier quarters. We've also taken impairments in earlier quarters on our stake in Bohai Bank, which we took a relatively small impairment in the fourth quarter. This is a kind of a mechanical calculation, value in use. We're properly provided.
Commercial real estate, of course, in focus as well in the West, in Europe, in the US. Do you see opportunities there, given the valuation drops?
Yeah, there could be. I mean, we're not going to be heroes in the commercial real estate market, but we're relatively underweight to improve the quality of our franchise, using our balance sheet in a prudent way, getting some of that asset growth that actually has been a bit elusive for us, getting that back in through some of the areas where our prudence has kept us out of harm's way. That's why we have such low loan impairments. Yeah, there's great opportunity.
It's starting to look attractive to you now. Commercial real estate.
Look, I'm not calling the bottom of any of that. I've also been in the higher for longer rate category, right? And I'm no pundit when it comes to interest rates, but it has felt to me that the U.S. job market is particularly strong. Wage growth is strong. That means higher for longer, and obviously that's what the market is saying now.
Well, that was the Standard Chartered Chief Executive Officer on great form, Bill Winters, speaking to our very own Tom McKenzie earlier this morning. Now, let's bring in Bloomberg's Steve Aaron. So, Steve, we heard from Bill Winters. He's always on good form. He's not been happy with the share price for quite some time. But today, finally, they're on the up.
That's right. I mean, people seem to like buyback, right? He's giving back a lot of money to investors, and they seem to be positively surprised. The share price is up. It's at a low level, let's face it, right? And he's right. He's pointing out he's been doing a lot of stuff to get it up. And I guess he's a bit disappointed. Investors have not reacted more positively in the past. Maybe he's now seeing this changing.
So because everyone's announcing buybacks, what's the outlook for buybacks in general? I know HSBC though also announced buyback, but that was maybe a bit disappointing. I don't know whether that's because they didn't commit to a lot more down the line.
I think that's true. The investors, all financial investors now expect buybacks really. Banks and financial services sector in general in Europe had a very, very good year last year. There were record profits in many, many banks. And of course, investors are demanding some of that to be paid out. And so the question for them is not whether there will be a buyback. The question is how high will it be. Allianz, the German insurance company, reported today too. They unveiled a $1 billion buyback as well, and investors are disappointed. So it's really not whether companies pay back money; it's how much they pay back.
So, who've been the biggest winners and losers in earnings this week?
Well, I mean, clearly, Stanchart now I think has shown a very strong upside. I think the outlook is good too, and so investors are positively surprised. HSBC, they had this big impairment that wasn't really, people didn't expect that and didn't like it when they saw it. So I think these two are comparing, that's a strong comparison. We also had Barclays, which unveiled investment banking sort of revamp of the whole bank, really. And we're going to have to see how that plays out.
So, Steve, Allianz also says it plans to buy back up to €1 billion of shares after reporting a 17% jump in fourth quarter operating profit. Now, the chief financial officer of Europe's biggest insurer also spoke to us earlier.
We have announced a 1 billion share buyback, which is building on the 1.5 billion share buyback we did already in 2023. So all of that is demonstrating, first of all, the confidence I was mentioning before, but as well, definitely, we have a long history within the Allianz Group of having very rigorous capital management. So we will continue doing that definitely in the future. We also, and that's also quite strong, if you look at our numbers, we have 162 billion of total business volume, which has been growing this year again, and we definitely have a focus on growth as well.
Well, that was Claire-Marie Coste-Lepoutre, the Allianz Chief Financial Officer, speaking to us a little bit earlier about their fourth quarter profit jump. We're back with Steve Arons. So Allianz, Steve, also plans a new buyback. What more can you tell us about that?
Yeah, exactly. So they're planning one to it. Investors were disappointed. And maybe one reason for that is, as the CFO just said, they actually paid back more last year, even though now they reported a record profit. So investors are asking, why aren't you giving us more money? It's also interesting that the CFO said in the interview that they're actually going to switch probably, or at least would prefer to switch to regular buyback announcements. So far, the announcements have come sort of periodically and have been sometimes a surprise for investors. So I think Allianz is trying to improve communications here with the market to make sure disappointment like today doesn't happen.
So interesting. Thank you so much. Our Steve Arons there looking at the banks in Europe. Now, coming up, a show of support for Ukraine 2 years on from Russia's invasion. We'll be looking at the state of the conflict next, and this is Bloomberg.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel, hence I did the all in one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision, that's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
year since Moscow's invasion of Ukraine, the U.S. is set to impose new sanctions on more than 500 people and entities linked to Vladimir Putin's war machine in a bid to squeeze Russia's economy. Well, Bloomberg's Samuel Etienne has more on the current state of the conflict.
2 years on since Russia launched its widespread invasion of Ukraine, the UN has recorded over 6.3 million refugees, with over 3.7 million people internally displaced. But there hasn't been much movement in terms of territory gained and lost. The land operation has not delivered long-term success, in contrast to naval efforts in the Black Sea, where Kiev has managed to unlock part of the sea route for exports. Now, in a bid to turn the tide of war, Ukraine has changed its commander-in-chief, President Zelensky selecting Alexander Syrsky, the former head of the ground troops there, to lead the armed forces. And military aid continues to flow into the country, with the US committing over $44 billion, dwarfing the UK and EU figures. But changing attitudes to support for Ukraine is a key risk for the next 12 months. In a US election year, former President Donald Trump and Republican Party members are questioning just how much longer the US can continue to support Ukraine financially. All of this as Russia has become emboldened and re-intensified its campaign in the east of the country.
Well, that was our very own Samuel Etienne reporting there on the conflict. Now, with the war heading into its third year, there's been a flurry of support for Ukraine. The G7 is set to call on Russia to completely and unconditionally withdraw its military forces from Ukraine. We're now joined by Bloomberg's MEA News Director, Rosalind Matheson. Ros, thank you for joining us. I don't know, I mean, is there a flurry of support, or is this just talk instead of sending them money and weapons which they need?
Well, it's that rhetorical statements that we're seeing from the G7, the Group of Seven, which is the US, Europe, Japan, and Canada. These are nations that have generally been strong backers of Ukraine throughout over the past 2 years, and certainly supporting them through money, through military aid, and also through this broad kind of statement of support. And so what we're seeing is that. What we're not seeing, of course, is the unlocking of major aid for Ukraine, particularly from the US. Even as this is happening, there's still $60 billion, which is locked up in Congress, and Ukraine says they need that money because they're running out of weapons, they're running out of ammunition. You can see that playing out now in the conflict on the ground, and they're saying, you know, this rhetorical support is important, of course, and the feeling that they're not alone in this, but they are kind of alone unless they get the money that they need.
It was also the first victory for Russia. I don't know whether you think it's a small victory, whether it's actually telling.
Well, it's quite a symbolic move around Avdiivka recently. You saw the Ukrainian forces pull out of there. We're also seeing sort of further progress from Russia a bit in the south and the east. There's talk about fresh pushes around Kharkiv, for example. So the sense is Russia feels it does have some momentum here. And is it going to try and make a major push around this anniversary, for want of a better word, that we're reaching the third year here? Do they feel that now's the time to push on? Because obviously Ukraine is running low on weapons, running low again on ammunition, artillery, and so on. If you've got a window of 6 months where that may not come, now's the moment for Russia to press the advantage.
I mean, will Ukraine actually get that U.S. money that's for the moment locked?
There's no path forward at the moment for it to happen. It's so locked up in the political space at the moment in the US. You know, it's a very febrile climate in Congress. You've got, you know, the run-up to the US election. You've got the presumptive Republican nominee, Donald Trump, saying to Republicans, do not do a deal here because it's not what we want to do. We want to pull out of this war, you know, if we can. And so there's just no path forward for that. No one's able to find a solution. And so is there other ways that Ukraine can get money? They're going to get maybe $900 million or so from the IMF, but it's nothing like the amount that they say they need.
So, Roz, I mean, two possibilities. Let's assume that you were looking at, you know, a Trump-Biden rematch. Let's say Biden stays in the White House. Still, if the war goes on for much longer, is this still a natural advantage to Russia?
Well, it's going to become harder no matter who's in the White House come the end of the year if this war is still going, whether it's Joe Biden or Donald Trump. I mean, Donald Trump says that he'll just try and end the war straight away. Joe Biden, of course, is a strong supporter of Ukraine, but even he is facing those political realities at home, and that is that there's growing questions around the financial aid for Ukraine. What is it being used for? Is it going where it needs to? Is there a point where you have to have those conversations about Ukraine sitting down at the negotiating table or looking to negotiate some kind of solution with Russia? That's only going to grow louder no matter who's in the White House.
But is there any doubt in your mind that actually if we have Trump in the White House, then he's going to be more friendly with Vladimir Putin, and his potential, negotiation is actually giving some sovereignty or giving territories to Putin, Ukraine territories.
Well, he just simply says that he thinks he can end the war immediately, so he'll get Russia and Ukraine somehow at the table and a solution. With that, and that really equates to is Ukraine agreeing to cede that territory. And, in the instant of getting a solution is just to say that the amount of land that Russia has taken, which is not insignificant in the east, the south, the industrial heartland of Ukraine, that Russia may as well just keep it at this point. I mean, that seems to be Donald Trump's solution. Whether Vladimir Putin would want to negotiate is also a question. Does he feel that he should just push on regardless? But that seems to be where the conversation is heading. Is there some kind of negotiated outcome?
I mean, he said in the interview with Tucker Carlson that the war could end tomorrow, if he got his terms. Do you take that at face value?
Well, his terms are really to kind of basically occupy all of Ukraine or to crush Ukraine. Does he need to roll into Kiev potentially to do that? Not necessarily. Can he occupy enough of Ukraine where you shrink the rest of Ukraine to not very much? That's possible. And of course, the big question is if that does happen at some point, what are his further goals beyond that? What are his long-term goals for Europe? Of course, he talks about Ukraine very much in this idea of the West versus Russia, and that Russia has to defend itself against this existential moment. And that includes Europe. So what does he intend to do beyond that?
Roz, the timing of, the murder of Alexei Navalny is, I don't know if it's perplexing, but is it because we're looking at elections in Russia very closely, and then you have, Joe Biden also meeting with his wife and daughter of Alexei Navalny? Are they now the figure of the opposition?
Well, either way, whatever happened to Alexei Navalny, he was obviously someone who'd been sick, but also someone, who Putin didn't want to have sort of there as he comes into elections. But if you put that together with the death of the Wagner chief, Prigozhin, who died in a plane crash some months ago, the message is just very clear. Like, you don't want to be opposing Vladimir Putin at home or abroad. We've seen, of course, this case recently of a Russian defector who's now apparently turned up dead in Spain. So very much this message is that he's got no tolerance for dissent either at home or abroad.
Roz, what does this all mean for Europe in 5-6 years? And there's talk about Europe needing to be stronger defense to look at any possible extra incursions from Russia. But can they really deal with it?
Well, that's the question. I mean, Europe's talking a lot about this idea of 5 to 8 years, that by then Vladimir Putin will have rebuilt his army to the point. Of course, he's taken heavy losses in Ukraine, so he'll be back at the point where if he wanted to, he might be in a position to strike further into Europe. And that's the real concern that particularly the Baltic states in Eastern Europe have. Whether he'd actually do that, it's very, very hard to tell. But the question then, is Europe ready? Because Europe stopped spending on defence. They really cut their defence spending for many years. Now they're suddenly trying to catch up, but they've got a long way to go.
Roz, thank you so much. Roz Matheson there, of course, in charge of our news desk. Coming up, a historic feat. A private company makes the first U.S. moon landing in more than half a century. We'll have all the details, and this is Bloomberg.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
This will probably go down in history as one of, if not the largest financial crimes.
Okay,
Today, I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Well, for the first time since 1972, the U.S. is back on the moon. The Intuitive Machines craft became the first ever private space vessel to land intact on the lunar surface. Now, the mission aims to provide NASA a close-up of the South Pole region and its systems. Let's bring in Bloomberg's Alex Webb. Alex, this is extremely exciting because there's been a string of failed missions, of course, from private companies recently. So how significant is this for just commercial aerospace?
It's particularly significant that it is an American company that's doing it. We've seen lots of other nations try to put landers on the moon: China, India, Japan, Russia. The thing is, of course, that it's where they've landed that is quite significant, because they've gone for the South Pole, and that is where there are some resources, potentially, not least water. They think they're sure there's ice there. They need to know kind of how much, because if you have ice, you can turn that, if you have water, you can turn that into oxygen and hydrogen, which potentially means you have the potential to create fuel to use the moon as a staging place for elsewhere, or just to send stuff back to Earth. So that landing position is quite interesting.
So who are Intuitive Machines?
Yeah, it's a company that a lot of the people worked at NASA. They've been going for about a decade, 11 years actually, but interestingly, they went public through a SPAC. Remember SPACs?
Vaguely.
A lot of those SPACs were sort of, in inverted commas, moonshots. Well, this is an actual moonshot, and it looks as though, it's now going to be above its, list price for the first time in about a year, going above $10, which is the price, of course, that all SPACs go public at. Seems to be benefiting from this. It's not been profitable yet, this company, which will not surprise you at all. But they do have a meaningful contract from NASA for this launch, $118 million it was, and now, of course, there are more launches coming down the pipe. It did launch on a SpaceX rocket, of course. It's just the probe itself that's made by Intuitive.
I mean, it's taken 50 years to go back to the moon.
Yeah, exactly. But, there's less of an impulse for it, right? The space race had some other motives as well. Yeah. It's also incredibly expensive. Something like 4% of the federal budget was used for the first moon landing. It's harder to justify that in the current context.
So interesting. Alex, thank you so much. I was quite excited about this piece of news. Alex Webb there, who covers tech and space for us. Up next, the Bloomberg Brief, Danny Berger and Manus Prani in New York. They have a full roundup of markets, space, and banks. This is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
I'm a conservative, but I'm not in a bad mood about it. Fellow
Bad mood
governors.
about being conservative. Is that because you feel like populism has taken control of your party?
And Joe Matthew.
What is it about race that bothers you about the new chairman of the Joint Chiefs?
Our military is becoming so political that we're going to go south when it comes to readiness.
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
I'm willing to have this battle. It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions.
Good morning from our world headquarters in New York. I'm Danny Berger. Manish Cranny is on assignment this week. Welcome to Bloomberg Brief. Let's set your agenda. Equities take a breather after NVIDIA's record-busting rally powered Wall Street to all-time highs. Top Fed officials hammer home the message that rate cuts, they're not coming anytime soon. And Reddit publicly files for a U.S. IPO in what may be the year's first major test of the market for a VC-backed tech startup. Welcome to Friday, the hangover after the AI party. And what a party it was. $277 billion added to NVIDIA's market cap. That is the most for a single stock ever. It was a huge day, so perhaps understandable that this is how the markets look. Maybe you want to take a breather. Maybe you're gasping for breath, but S&P futures, they are little changed. NASDAQ futures down about 0.2%. But thanks to NVIDIA, we had the S&P, the Dow, the NASDAQ 100 all hit all-time highs. Now, small caps, they didn't play along as much. Unfortunate for my beloved small caps. But Bank of America did say that the flow into small caps over the past week was the most since 2022. So is the tide maybe changing? We also had some economic data showing the resiliency of the U.S. That didn't phase U.S. equities. Maybe it meant good news is still good news. But for yields, they did march higher. It wasn't just that. It was also this parade of Fed speakers who came out and to say, have caution on rate cuts. We are not there yet. Or if you're a cash car, you say we have more work to do in bringing in inflation. So yields touched the highest levels of this year. 4.34% is where we stand, 2 basis points higher again this morning. It's remarkable to think that at the start of the year, this was below 4%. We have come a long way in repricing cuts. Bloomberg dollar spot, it's higher today, but headed for its first weekly loss of the year. NYMEX crude down 1.5%, potentially some fears about what it means to get new sanctions from the U.S. against Russia today. Those will be unveiled later. But the predominant theme is caution on rate cuts for this rate market. And we heard from 3 top Fed officials who had that message, saying they're still on track to cut interest rates this year, but not anytime soon.
I do believe that we may be in a position to see rates decrease this year. But I would caution anyone from looking for it right now and right away.
The labor market can change dramatically. We have to be careful
And we have to try to assess the different shocks that can hit the economy.
I would like to have greater confidence that inflation is converging to 2% before beginning to cut the policy rate. I would see an eventual rate cut as adjusting policy to reflect a shifting balance of risks.
I'm going to need to see at least another couple more months of inflation data before I can judge whether January was a speed bump or a pothole.
Well, based off different thinking from Fed officials now, Jan Hatzius and the eco team at Goldman Sachs have now pushed back their bet on the first rate cut until June. Now, another part of Goldman Sachs, the strategy side for these markets, is writing central bank cutting cycles have historically been supportive for risky assets, but maybe less so this year, as markets have already pre-traded much of the rates relief. Joining us now is Christian Muller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Christian, really great to speak with you. It seems like we're at a moment of pausing and rethinking these markets after a monster rally yesterday. It wasn't about rate cuts, but it added to what we've already seen. So you say, look, we've already priced in the rate cut palooza, but at this point, have we maybe even gone too far? Is a pullback necessary?
Well, I think it depends on the drivers of the market. Like in the fourth quarter, you definitely had rates relief being a main driver of risk appetite. You had this big rally in 60-40 portfolios, and that was the main story that drove equities as well. And I think since the beginning of the year, we're starting to see a bit of a shift towards a more reflationary backdrop, kind of equities up, bonds down. And that requires growth and growth optimism. And we've heard from you before, I mean, you have growth optimism for specific companies that are boosting the equity market. And these are very large companies within the index, so they can actually boost the index. And on top of that, you actually start to see the growth picture improving and taking over a bit as a driver from rates. So I would say that, yes, you're right, you're vulnerable that at some point there's a rate shock because it's too much of a good thing. But as of now, markets are doing quite well, despite the fact that rates are not coming down.
And so are you comfortable with that? Would you be buying every dip at this point?
Listen, with everything we know, we expect relatively good growth in the US this year. We expect better growth in the rest of the world, so improving growth. In particular, manufacturing is expected to recover further, and we've had some good data there with PMIs picking up a bit. I think the growth backdrop is good. If you have a setback right now because of rates shifting up further and scaring investors about growth again, it very well might represent an opportunity to buy a dip again. A bit similar to what we had in the summer last year with the bear steepening. But what's critical is, of course, that just like what happened then, you have to have the central banks acknowledge that type of rates move going too far. Because that eventually drove the relief after the summer bear steepening episode, because the Fed and also at the time the Treasury reacted to the moves in the back-end yield. So at some point you need the central bank to react to the rates moves.
Right. And Christian, I know you like 60-40 as a portfolio construction. I mean, the poor 60-40 has been the butt of every joke, it feels like, since COVID. But okay, it comes back. But there is this moment where if we do get that sort of rate shock, we have learned the lesson that bonds don't protect you when equities are selling off because of inflation. Is it your estimation that that sort of environment would be temporary and the correlation goes back to normal?
Yeah, I mean, we have to be clear. We were also quite bearish on 60-40 at the end of 2021. We wrote the balanced bear report, but we've turned a bit more optimistic about the prospects exactly to the reason you just mentioned. Inflation actually has come down a lot. And while the Fed is waiting because they're worried about re-acceleration risk, I think if you would have a significant shock right now to growth, the bond market would most likely buffer you. And from that perspective, we think 60-40 is becoming more useful, but there's plenty of ways you can make it more robust. For example, the growth and inflation picture is much weaker in Europe. So maybe you should look for adding duration in Europe rather than adding duration in the US. Similarly, if you're worried about too much of a good thing and rate expectations continuing to move higher, so pricing out the cuts, that might be more of a problem in the US. You could look at the dollar as a hedge in a multi-asset portfolio. So I think you can protect a 60-40 portfolio right now much better than what you could do in 2022.
Well, speaking of hedges, these volatility markets have been remarkably calm for a year of uncertainty. The VIX is still around 14%. It's getting closer to being on the dot, 14% after the rally of yesterday. Are these option markets too complacent, Christian?
I don't know, because to some extent, the macro conditions, as I mentioned in Q4 in particular, they had very much the flavor of Goldilocks, where growth was actually resilient in the US, even better than most people expected, and inflation continued coming down. That normally is a very carry-friendly backdrop that anchors volatility, that anchors risk premia. I mean, as I mentioned, since the beginning of the year, you've shifted a bit more towards reflation. And that isn't always as friendly for volatility, but it's certainly not pointing towards significant spike risk. I would say that volatility right now is probably roughly where it should be. We have like a volatility regime model based on current macro conditions, which roughly tells us that we're fair in terms of the levels, but it doesn't change the fact that there can be unanticipated shocks. There can be changes in market narrative, as I mentioned earlier. So I would just say, as a multi-asset investor, you want to think about hedging. You want to think about simple equity puts as a hedge for your portfolio in case there are setbacks.
I appreciate simple because I don't think I'm ready to talk about the Greeks, the deltas, the gammas at 5 a.m. in the morning, Christian. So I definitely appreciate just a simple put strategy. Look, the other thing we've seen in this market, we've all been obsessed about the run-up in NVIDIA, but the run-up in credit, I've been talking about it all week because that has been remarkable. Spreads continue to tighten. And I know you say that while you expect modest equity returns, the risk reward is more attractive than for credit. What do you make up of the run in credit? Bank of America says it's a bubble-looking kind of environment. Would you agree with that?
I think you're right. It's again similar to the VIX. You've had this Goldilocks regime, and Goldilocks is very good for anchoring volatility, and credit spreads are a bit like volatility, like long credit is short equity put. So from that perspective, the two assets are linked. You've had a major carry rally last year in function of Goldilocks, in particular in Q4. And to some extent, that means that the current credit spreads, they offer you relatively little upside convexity. There's very little opportunity to have a significant return because you get paid the spread. It's very different to equities. As we've seen, earnings can still drive significant upside surprises. You have valuations that are less of a binding constraint. For credit, I think we're reaching the point where you could argue for a speed limit from valuations. Does it make us massively bearish credit? No. We're still underweight. We've shifted overweight equities, underweight credit recently because we just don't think it's a particularly attractive risk reward at this point. That doesn't mean we expect any major credit crunch issues or any major deleveraging pressures or pickup in defaults. We just think that the returns are going to be relatively modest compared to the type of risks you're taking.
Yeah, I like that, a speed limit. Christian, I just have to tell you, leave you with this thought. The other favorite thing I've heard this week is it's not Goldilocks, it's platinum locks. Apparently that's what we're expecting now, a platinum blonde Goldilocks. Hey, Christian, we're going to have to leave it there. Thanks for joining. Enjoy your Friday and your weekend. Christian Miller-Glissman of Goldman Sachs International. Okay, let's get to some of the other top stories that are trending on the terminal this morning. Shares of Intuitive Machine are soaring after their lander touched down on the moon. Soaring might be a space pun, that's nice. It's the first time a US-made spacecraft has made it there in one piece since 1972. The mission aims to provide NASA a close-up of the South Pole region and its systems. The U.S. will announce sanctions today that will target more than 500 people and entities linked to Russia's war machine. President Biden says they're designed to punish Vladimir Putin for Alexei Navalny's death. Biden met with the opposition leader's widow and daughter yesterday. Starwood Capital Group Chairman Barry Sternlicht says that the U.S. banking system's exposure to declining commercial real estate values is one reason for the Fed to cut rates.
I do think the economy is softening, and I do think the Fed, particularly Janet Yellen, she's changed her tune recently. You've heard her talk a little about the regional banking market. I think they're worried at the $1.9 trillion of loans these banks are holding, real estate loans, which is up materially since pre-pandemic levels, and valuations are obviously down. So there is a giant skeleton in the closet in the regional banks. I think the Fed is aware of that.
AT&T says a widespread outage that took hours to resolve yesterday was caused by a, quote, incorrect process while expanding the wireless network. The software issue interrupted wireless service for hundreds of thousands of subscribers and prompted the FBI and U.S. Department of Homeland Security to investigate the outage. Speaking of phones and services, coming up this hour, we're going to be speaking with the Deutsche Telekom CEO Tim Huckus about the company's strong forecast for the year ahead. But first up next, have the markets gotten Standard Chartered wrong? We're going to break down their results and hear why Bill Winters says, I'm not happy about this share price. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We're not happy with the share price at all. And I think we ask ourselves the question all the time, why? Why does the market not recognize what we see in terms of the value of this business? And I think part of that is that there is a sense that it's hard to get things done in Standard Chartered. And this Fit for Growth program is going to tackle that head on. There's a sense that our cost base is high relative to our income. Now, obviously, there's two ways to deal with that. One is to get the income up, which we've done quite successfully. We'll continue to do that. And the other is to make sure that the cost grows slower.
Standard Chartered CEO Bill Winters there complaining about the bank's market valuation. Standard Chartered also in that announced a $1 billion buyback and delivered a profit beat. Let's bring in Bloomberg's investing and finance editor, Tom Metcalf. So Tom, in that interview, he says, we're not happy with the share price at all. In a press conference, he said that the market pricing is a word that I can't say on TV. So he clearly is unhappy about how the market is treating Standard Chartered's share price. But is this enough to change things around? He's doing the shareholder-friendly thing of increasing their dividend. Is this going to make it a bit better for him and erase his complaints?
Yeah, Winters not holding back today, definitely using colourful language on that press conference, as you say. You know, it's tricky. I mean, you look at how the share price is performing in his tenure. It's actually down 40% since he started in 2015. It did perform okay over 2023, up 7%. But, you know, that's against a backdrop of rising interest rates. So I think investors in Standard Chartered are probably feeling a bit hard done by on the share price. And look, as he's saying, there is a bit of head scratching at Standard Chartered. Like, why are we getting dinged so bad? You know, we're trying to deliver these buybacks. We're keeping fairly okay constraints on costs. And so it's an interesting thing. It's sort of what more, at least from their perspective, can they really do? You know, shares are up 7% today on these results. So it does look like, hey, look, if they can really keep that focus on capital returns. And I think for them, the key is, can they keep those costs, like growth lower and perhaps ideally even cut costs? So this is what is behind that program he outlined in terms of sort of future growth, and that is what they're probably going to focus on.
I mean, some of the issue, not just their China exposure. I mean, we've heard from banks earlier in the week, HSBC, who had to log some impairment charges when it comes to their China exposure, a specific bank there. But does Standard Chartered not have the same China exposure problem? I mean, buybacks and a new program aren't going to fix that.
Well, no, certainly they do, and they've taken actually another impairment on one of their Chinese investments again this quarter. Look, I think they take the sort of long, medium-term view and say, yes, it's a tough time right now for China, but you've really got to see the long-term investment picture. And an economy growing at 5%, yes, that might be bad for China. That every other country in the world will probably be delighted with that. So, I think they just see that as a long-term view. They're not going to change, that sort of posture they have towards Asia and China in particular. And I think that's probably the biggest disconnect, as you say, between what investors are currently valuing and what the bank thinks they should be valuing.
Well, Tom, I'm not letting you go without asking about pay and bonuses. Winter's got a bump, 22%. The overall bonus pool for the bank fell by 1%. We've learned a lot about bonuses in Europe over the past week. How does Standard Chartered stack up?
Yeah, I mean, I think it's a really interesting dynamic you see both at Standard Chartered and HSBC, where, CEO Noel Quinn saw his pay double over 2023. And that's all against this backdrop of, pretty tepid bonus pools at those firms, and also just generally a bit of a grim year for, I guess, Wall Street's rank and file. Lots of cost cuts, lots of chatter. So I think, a few folk at the banks, headed up by these CEOs seeing pretty decent pay rises will probably be slightly disgruntled by it all.
Tom, thank you very much for that. That is Bloomberg's Tom Metcalf on Standard Chartered. All right, let's get into tech, because after more than 2 years on the sidelines, social media platform Reddit is finally moving ahead with its IPO in what could be one of the biggest listings of the year. Joining us now is Bloomberg's Alex Webb. Alex, you know what my favorite Reddit thing is, and it has literally nothing to do with this story, but all the social media posts when you see Alexis Ohanian, of course, the founder of Reddit, be spotted, and everyone, the only thing they say to him is, "Aren't you Serena Williams' husband?" So here we go, Serena Williams' husband finally filing for an IPO. Why now, Alex?
Well, it looks as though finally the IPO market is warming up a little bit. We don't want to get too carried away, but we've seen a few listings in recent weeks, in the past month or two. Immerse Sports went public at a 1.7 billion, I think, valuation. In the middle of last year, towards the end of last year, we saw a few companies go public, not least Arm. They were a bit disappointing, so there was a slight sharp intake of breath. Is the market there yet? Didn't look like it. Now, it looks like it might just be starting to open up. Equity markets are still doing pretty well. The thing that's interesting with Reddit in particular is I wonder if they're going to try to spin some sort of AI story, because we have seen a few deals come through from them now where they are essentially licensing a lot of they're giving AI companies the ability to train some of their algorithms on Reddit's data. So it'll be interesting to see how the marketing shapes up as this proceeds.
Right, because I'm assuming they need something like that, a little bit of an extra edge, because in getting the spotlight and getting a look into their books, this isn't a profitable company yet, Alex.
Yeah, I mean, it is a loss-making company. The size of that loss appears to be diminishing. The challenge is that during the pandemic a few years ago, they raised a $10 billion valuation, and what Bloomberg's reporting suggests is that actually they're being advised to seek a valuation in inverted commas above $5 billion. So that would be, a bit of a discount depending on who and what level the investors came in at. Now, of course, just because they go public at $5 billion doesn't mean that there wouldn't be headroom further down the line. Something, of course, we've seen with Arm. Their shares now are, trading quite a bit higher than the IPO price, following some recent news flow, but that is perhaps a challenge for some of the existing investors.
Yeah, fair enough. And I mean, if you had that huge bump in usership during the pandemic, maybe it makes sense. Maybe not a haircut of half of your valuation, but maybe it makes sense to pull back as things get back to normal. Alex, thank you so much. That is Bloomberg's Alex Webb. More to come from Manas's trip to Miami. It's going to be nice to be in Miami right now. It is a foggy morning in New York. This is Bloomberg.
I'm from the UK and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision, that's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
By 20%. So we have not noticed anything impacted the plan of the investment in Saudi Arabia. However, it's in the interest of Saudi Arabia to have peaceful region and everywhere.
Saudi Arabia's Deputy Minister of Investment speaking to Manus Cranny in Miami. I still have not forgiven Manus for shipping off to Miami for the sun while we're stuck here in rainy New York. Okay, a quick check on commodities this morning. They did participate in the risk rally yesterday, but something different is happening today. NYMEX crude and Brent crude down at least 1.2%. Commodity traders are on alert for the next package of U.S. sanctions against Russia. Yes, crude flows are already subject to sanctions, but the efforts might give them an extra push. So most commodities under pressure this morning. Okay, coming up, Europe's biggest telecoms operator is optimistic for the year ahead. We're going to speak to Deutsche Telekom CEO Tim Hutgus next. This is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
Research that's taking place
lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Not coming anytime soon. And Reddit publicly files for a U.S. IPO in what may be the year's first major test of the market for a VC-backed tech startup. Now, while the broader market is taking a breather this morning, NVIDIA's not. Because of course it's not. It's still up in the pre-market, up 2%. So if you were worried that you missed out on this rally, hey, it is still going. Now, that's not a recommendation to buy. It is just to say, here we are. S&P futures, little change. NASDAQ futures a bit lower, but we hit new highs on the S&P, NASDAQ 100, and Dow. There you go. How's that for an AI party? Russell 2000 futures, those are down by about 0.5%, but Bank of America did say that flows there were the most over the past week since 2022. Meanwhile, when it comes to this yield story, maybe we're more concentrated, less on the party going over at equities, what's happening with NVIDIA, and pure and simple, Fed speak and data. Data showing a resilient economy, Fed speak voicing caution. We heard from speaker after speaker, Jefferson, Harker, Waller, Kashkari, all of them saying, don't look for a rate easing right now. We still have a ways to go. Bloomberg Dollar Spot headed for its first weekly loss of this year, though it is slightly higher this morning, slightly stronger. Meanwhile, NYMEX crude down 1.25% as the U.S. gears up for 500 new sanctions against people and entities in Russia after the death of Alexei Navalny. Okay, let's get back to the corporate story because we had earnings this morning from Deutsche Telekom forecasting a year of earnings growth ahead to follow a strong 2023. The bond-based mobile operator has bucked trends in European telecom, boosted by growth out of the U.S. and Germany. Joining us now is CEO Tim Höttges. Tim, thank you so much for joining us. Look, one of the things that stood out here is the strength of your cash flow, set to increase 16%. Now, I look at that, and I have to ask Tim, it begs the question, does that mean shareholders can expect greater cash return to them in 2024?
Good morning, Danny. Yes, we have a very strong year, very strong operational growth. And by the way, if you do the right things, you cannot avoid that you make money. And we had an increase already to 16 billion free cash flow this year, and we are expecting an 18.9 cash flow in 2024. So, and as we said, we have a clear payout policy, yes, with the growth of our earnings per share. So, we are as well expecting, let's say, that our dividend is growing again. This year, we are proposing 10% increase to 77 cents, and hopefully then, with achieving what we have in mind for this year, we're going to increase again.
Okay, what could that look like? What's kind of the upper end that you'd be targeting if 10% is your baseline at the moment?
Look, we had a 160 earnings per share this year, and we are aiming for a 175 earnings per share for 2024. Beyond that, can be higher. That's what our aspiration is, but 175 is where we are aiming for.
Tim, you also had a mix of the huge strength in the U.S. with T-Mobile. I don't think that would come as a surprise to many, just because it is a strong market. We've seen in the data time and time again, the U.S. is resilient. But you also had growth in Germany. The data there isn't as friendly on a macro level. So how would you describe the quality of growth in Germany, just from your results themselves? Do you think maybe the German economy is healthier than it would seem from, again, that headline macro level?
By the way, Germany is still a very robust country, despite this low growth rates which we have seen, over the last 2 years. But I would say Deutsche Telekom and the sector is, a different animal. And I think what the success of our company is, we have invested over the last 10 years 170 billion euros into the infrastructure. We are now leading in all the markets where we are with the best infrastructure, with the best service, and our brand is the most valuable telco brand in the world. And I think this is driving more customers into our ecosystem than any other telco. We had 5.6 million new customers in the US. We are growing in all the markets where we are operating. There's not a single market where we are not growing. This is helping us to better utilize this expensive infrastructure we have invested into this one, and this is helping us to grow. And this growth is then reinvested into the operations, and here we are. So I think we have, a special effect at Deutsche. Comparing us with the European telcos, we show more customer growth than the others, despite the fact that the European telco sector is more difficult and over-regulated compared to others.
It's overregulated. What would you like to see change then? Because the European Commission had outlined some broad features that they want to see in order to help the European telecom market. What needs to change in what they recommended? What is still the missing piece to help the overall industry?
The first thing I have to sell Deutsche here, and there's no other telco stands on two legs, an American one and a European one. Most of the other telcos are just standing on the European leg. And the European environment, what we have is we don't have a kind of one market. It is 27 markets, if we are honest to each other. We have 27 markets with different spectrum policies. We have 27 markets with an antitrust. We cannot realize economies of scales like we have seen that with the Sprint T-Mobile merger in the US, where we are, created a size which is now helping us to build a better infrastructure for our customers. It is too fragmented. It has too many policies. And on top of that, you just saw, the merger of MásMóvil in the Spanish market. There are too much restriction when it comes to intra-market consolidation in our environment. This is not helping the ecosystem. The profitability of our market is lower than it is in other markets. And you need size in our industry to succeed.
Tim, I have to say, I think it's quite fortunate that you had earnings today and not yesterday, because it did seem like any telco news was absolutely blown out of the water by the AT&T outage, at least in the US. Let me tell you, Tim, it was all anyone was talking about because they couldn't get on iMessage and text their friends. Yes. Now, Deutsche Telekom, T-Mobile had an outage last February. So you've lived through that experience of mass outages that dominate the news cycle. How damaging is that type of thing to reputation?
Outages is the worst case for a telco. We are here to connect the world, and people should always stay connected to their businesses, to their spouses, and all this kind of things. So, it is our purpose to connect people. So therefore, the outage is for us, the worst case what can happen. So that is why we're investing so much in the resilience of the infrastructure. But you see how vulnerable this infrastructure can be. I do not know something about the AT&T situation, but I can tell you one thing, knock on wood, I haven't had a single outage here in Germany over the last 10 years as a CEO, which was so severe. So therefore, we have to invest into the resilience of the infrastructure because it's the right aspiration that people always want to stay connected.
Do you think your peers then aren't investing enough if this is still happening to a giant like AT&T?
Look, by the way, I think sometimes we are underestimating the complexity of the technology of telcos, and you see, how complex the infrastructure can be if you change software, if you have release changes, or if you change the infrastructure. So we have to invest into this resilience, no question about that one. And with all the new services sitting on this infrastructures, think about IoT, think about, let's say, the corporate communication services in fiber and in 5G services. It shows that the security and the safety of this infrastructure should be always up on our mind. And I can tell you one thing, the T stands for trust as well, and the trust that our infrastructure always works. That requires a lot of engineering skills, by the way, and a lot of investments as well.
Wait, are you being serious? Does the TNT Mobile stand for trust, or is that just something you say?
Look, no, but it is the way how we are communicating it with my heart, So we are one company in the world, and by the way, our US team is doing a lot of efforts, when it comes to data security, with the modernization of the IT infrastructure, a lot of investments going to that, into this area. And I just saw the report of auditors and others, how much, progress our company made. I'm very happy, that this fast-growing company, T-Mobile, as well, is so much focusing on the security.
I got to ask about one of the fast-growing areas. By the way, I do think you should tell your marketing team, have that T on your turtleneck and just write Rust underneath, so it does say trust. I think that'd be a good adjustment there. But look, while we're talking about things fast-growing, there was this press release that you and the team put out that at Mobile World Congress next week, you're going to reveal a phone that has no apps and is just AI. Tim, my tiny little peanut brain cannot comprehend what that would actually be. What is this future you're pitching to us, this appless future?
Danny, I doubt that you have not enough brain on that one. It's a very simple one. The world of apps, for me, by the way, for next year's maybe stays, but long term, no way that the app world will survive. You don't need it. By the way, I do not want to open up apps. I do not want to always, being registered. I don't know that the app's doing something in the background of my mobile phone with my data. I do not want this complex administration. I do not want to pay for app stores as a developer. So what you want to do is you want to have the use case of the app. You want to get access to the weather. You want to shop something. You want to let's say, use the functionalities. But why do I open an app for that one? And the future of that one is that artificial intelligence software will use these functionalities. It will be like you ask something and the system itself will find the right functionality to give you the single answer which you require. And this makes our life much more convenient. And this is something we're going to show. It is in a very early stage, so it's not, being on the market tomorrow already, but this is the future. We will ask and we will get it.
I was going to say, where do I sign up? But clearly I'm not allowed to sign up yet, Tim. So how long is this going to take? When is this the future? When can I sign up and I'm no longer going to have to scroll on my phone to find apps?
Danny, good that you're excited, but I don't want to preempt the story of the Mobile World Congress because we are today in our report of the great numbers which Deutsche Telekom and T-Mobile has presented 23. Let's meet us again on the Mobile World Congress in Barcelona, and then I'm going to tell you all the details on the phone.
Okay, it's a deal, Tim. Thanks so much for joining us this morning. Enjoy the rest of your Friday and your weekend. That's Deutsche Telekom CEO Tim Höttges. Okay, coming up, we're going to discuss the risk of a recession with our next guest, Ruqayya Ibrahim of BCA Research. That's on deck.
Was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger in New York. Manus Cranny is out on assignment. Now, stocks are ending the week on a calmer note, let's say, as investors look over the outlook for equities just at a moment after they hit an all-time high in the wake of NVIDIA's blockbuster earnings. Another way to say that is maybe we are suffering the hangover of a big rally yesterday. Joining us now is Ruqayya Ibrahim, strategist at BCA Research. Ruqayya, you write that equities are expensive. Now, I don't know if you wrote that before yesterday because they just got a lot more expensive at all-time highs. So what do you do with a market like this? Do you wait on the sidelines to buy the dip, or can you participate?
Hi, Danny. Thanks for having me on. Yes, equities are expensive. And, you know, this is all based on what we've been seeing over the past year with big tech. I think the risk here is that, you know, the use case, I mean, the technological progress is definitely extremely exciting, but the use case still has to be proven. You know, the future earnings are still uncertain. So, you know, I think that they are getting a little bit stretched, but I wouldn't bet on, you know, timing a bubble. So I'm not going to, you know, try to do that. But what I can say is that over a longer term horizon, so over, you know, a 12 to 18 months, I think the economic outlook does seem concerning. Now, until we do see cracks, like the U.S. economy, I think for now is quite resilient. So I wouldn't stand in the way of, you know, potentially equities moving higher, but I wouldn't really take on a very strong position there. So, you know, over a near-term horizon, we're pretty much neutral on stocks. You know, there is still potential for cyclicals to continue to outperform or to outperform defensives over the near term. But, you know, over a cyclical horizon, that's when we start to get a little bit more concerned.
And that totally lines up with what we've seen in the past, Ruqayya, this idea of, okay, recession might be coming, but maybe you can't trade on it now because we've had so many head fakes. So if your estimation, you see a potential recession late this year or early next year, what do you wait to enact that recession playbook? Do you need to see the whites of the recession's eyes?
Well, actually, what we're already starting to see is some signs that this is coming. And if you take a look at the labor market, you know, the headline numbers, they're all very positive, very strong monthly job growth. But underneath the surface, you know, the hiring rate, the quits rate, the job openings rate, these are all falling. And they're warning of, you know, a further deterioration in the labor market as it comes into better balance. Now, having said that, there's still 1.4 jobs per unemployed worker. So even if companies stop hiring, you know, it's the labor market is still resilient for now. But eventually, I think that it's going to start catching up. We're going to start seeing the unemployment rate start to rise. And, you know, as these conditions get closer and as the tailwinds that we've seen that has prolonged this expansion, such as excess savings, continues to fade, I think that's when we're going to start to see that, you know, the recession is really getting closer. And, you know, whether or not the Fed is, or we don't actually expect that the Fed is ready to, you know, start cutting rates preemptively, that would, you know, prolong the expansion phase. And so I think that's something that we're watching very closely as well.
One of the most remarkable things of where we are right now is how folks can look at the same data and come up at polar opposites. I would say you're somewhere in the middle, but you look at someone like Fidelity's George Estathopoulos, who's dumping nearly all of his U.S. Treasury holdings, saying that he expects the U.S. economy to expand. Then you look at Jupiter, who's loading up on Treasuries because they think the Fed might cut something like 400 basis points because of a recession. Ruqayya, in your more measured approach to some economic weakness looking like it's on the horizon, what do you do with Treasuries? Again, where you have these polar opposites of someone backing up the truck and loading up and someone selling off the entirety of their Treasury holdings.
Right. Well, I do think that treasuries are starting to look more attractive. They have increased, but we don't expect them to rise above their cyclical peak that occurred over the fall. I think over the near term, really they're going to be in this trading range that they've been in, whereby the inflation rate acts as the ceiling on where treasuries yields are how much yields can rise, and the labor market acts as a floor. But as we near this recession and as the labor market deteriorates, I think that's when you're going to start to see greater potential for yields to decline. So for now, we're at benchmark. We're neutral on treasuries, but we're looking over the coming months as the labor market starts to deteriorate, as investors reduce their expectations about the extent of rate hikes that are coming rate cuts that are coming over the coming 12 months. That's when we look to turn more bullish on treasuries.
And in that environment, does the correlation, the negative correlation between equities and stocks come back into force? Because when we're worried about inflation, it certainly didn't work out that a classic markets economic textbook would tell you it did.
Yeah, I think as we near a recession, we're going to start to see the treasury yields start to decline, and we're going to start to see equities also fall. And I think that that's where, that's what our expectation is over a 12 to 18 month horizon, but not necessarily over the coming months. I think that over the coming months, there's still potential for equities to rise further from here, and there's still potential for yields to rise as well.
How much are you concerned about when that equity fall happens, that it's a very concentrated market? Just bringing it back to what we were first talking about. Does that make the pain all more acute when it has been just a few names? It was 7, then 6, and now it seems like one stock leading gains?
Yeah, the market is extremely concentrated, but our expectation is that it's going to be a garden variety recession. It's not going to be something too severe. We don't really see any significant imbalances in the U.S. economy. Our expectation is that, as the economic conditions deteriorate and the earnings growth start to decline, that's what's going to pull down the equity market. And, our forecasts are based on an earnings decline of about 10%, which is, roughly what you would typically see during a recession.
But Rakaya, what would you say to folks who say, look at this current quarter's earnings? They are strong. There are a little signs of, Nestle's of the world maybe talking about not being able to hike prices enough, but for the most part, margins are strong. What do you say to people who say, why can't that continue? Why can't corporates continue to do well?
Well, I think that, on that note, it's like I said, the U.S. economy is still doing well. And that's why, I think that there is still potential for equities to rise over the near term. But, the margins are going to get squeezed. Wages are stickier than prices. And, we're already starting to see that corporate pricing power is deteriorating. And that's going to also be something that's going to weigh down on the bottom line. So I think that, what we're seeing now does reflect the resilient economic conditions current economic conditions. But if we look further ahead, that's when we start to see that the trends are going to be a little bit more concerning.
Okay, Rakaya, really appreciate your time this morning. Thanks for joining. That's Rakaya Ibrahim of BCA Research. Great. A quick check on your currency markets as we head towards the commercial break, and they are a little change. It was a wild ride for currencies yesterday. First, the euro got this huge boost thanks to strong French PMIs, but then the U.S. data comes in and shows resiliency, and that tempers all of the euro bulls' excitement. So a little change across the board, but for the week, the euro is stronger versus the dollar. This will be the dollar's first weekly decline of the year. Okay, coming up, we're going to take a look at some of the market-moving events to watch throughout your trading day on this Friday.
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is your Friday edition of Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading week and the weekend. Here's what's ahead. The U.S. is planning to unveil sanctions against Russia today after the death of Alexei Navalny. Then on Saturday, Donald Trump and Nikki Haley battle it out in the South Carolina primary, which is Nikki Haley's home state. And then also on Saturday, we're going to get Berkshire Hathaway reporting earnings. Those will come at 9 a.m. Eastern. Okay, in the meantime, I got some micro movers to show you. Some of the things that are moving in your pre-market trade. Block shares surging this morning, up more than 13% after the payments company reported results. First quarter expectations, they all exceeded analyst estimates. Now, NVIDIA, after adding $277 billion, it's apparently not done yet. Shares are up by more than 2%. It's currently up the most in about 9 months. It's all about AI. The party is continuing today, even though we're just talking to our last guest, Ruqaiya Ibrahim, who said, yes, this is an expensive market. Now, we're also back in the moon. Intuitive Machines is soaring after becoming the first private firm to land a robotic spacecraft intact on the moon, up some 43%. I'm pretty sure that this was a SPAC when it first became public. So, hey, SPACs are kind of back. Okay, a check on bonds as we near the end of the hour. Yields are moving higher across the board. Now, we had a lot of hawkish Fed speak. I mean, hawkish, they're still talking about cuts to end the year, but they're saying it's not going to come as soon as you might think. That prompted Jan Hansis and the team over at Goldman Sachs to say, we don't think a cut's going to happen in May. We now think it's going to happen in June. The market also moving their expectations higher by about 2 bips throughout this global bond market. All right, that's it for Bloomberg Brief. Surveillance will take it from here.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
DOJ or other authorities.
Could face bigger challenges. Britain's next.
Was going to keep Great World Cup. This is a story
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think the equity market's sort of really nicely sort of set up from here.
There's lots of opportunity within this market.
But there's the overall tech market. I mean, to get out the popcorn movement.
Even at rich valuations, it is going to be earnings growth that is going to drive the market.
We're starting with the Magnificent Seven, but over time we see the gains and the positivity spreading.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, your equity market on the S&P 500, coming off the back of the biggest one-day gain of the year so far. Equity futures totally unchanged this morning. Stacked lineup. Bramo is out. Peter Cheer of Academy with us for the next 60 minutes on this program. Peter Cheer, we've got to talk about one single name, NVIDIA, and let's go through these numbers. $276.65 billion in market cap in a single day. And allow me to go through the list of companies that have a market cap smaller than that big one-day gain just yesterday on NVIDIA. I'm talking about Salesforce, Netflix, Bank of America, Coca-Cola, Pepsi, McDonald's, Disney, Intel, Verizon. The list goes on and on. Peter Cheer, yesterday, we added a Pepsi to the market cap of NVIDIA.
Yeah, it's been almost insane. We saw, what was it, on February 2nd, Meta did almost the same thing, right? That was $200 billion, which seemed like a huge number at the time. This is even bigger. What did Wall Street get so wrong that it was off by that much? And I think Wall Street didn't actually get that much wrong. It got a little bit overdone. And even if you go back until like later in the morning, it was back to levels that it traded at last Tuesday. So as exciting as it is, it also dropped $150 billion in a week. So
this is the disconnect that I think we've been talking about around the table. Anne-Marie was talking about it yesterday. I was as well. We're only talking about a beat on the forecast of $2 billion US. And that beat of $2 billion seemed to unleash a rally, not just in a single name, not one sector, one country, but across the planet. Pete, can you make sense of that?
No, to be honest, and I think I look at it, so you look at the NASDAQ 100, I think it was just below 18,000 on February 9th, 2 weeks ago. So yeah, it's an all-time high, but it's barely an all-time high. I think it's everyone's forgetting, we sold off pretty hard on Tuesday and Wednesday coming into the earnings. We bounced into the close, then it rallied hard yesterday. I think this was kind of, to me, it's almost the last gasp. Everyone now who was caught short, everyone who was uninvested is pulling in. And I understand what's going on. We really like AI. We believe AI is going to change things. The problem is, did it get too expensive? Is the data ready for AI? And if it's really going to work, the rest of the market has to be successful. It has to translate into overall PE rise for everyone.
I've got your read in front of me. This is what Pete's got to say for the next 60 minutes. I'm reloading to the full bear mode. We can find out what full bear mode means in the next couple of minutes. Let's turn to the price action to get your Friday set up. Equity futures on the S&P 500 looking a little something like this. Equity futures on the S&P pulling back just a touch. We're negative here by 0.03%. In the bond market, yields climbing again, up 2 basis points on a 10-year, 434. And in foreign exchange, totally unchanged on the euro, 108.23. Joining us through the next 60 minutes, coming up on the programme, Marky Patel of Allspring, with US stocks pushing all-time highs. Pierre Ferragut of New Street as NVIDIA smashes records for a single day. And Matthew Bartlett of Derby Field Advisors as Nikki Haley vows to stay in the race against Donald Trump. We begin with our top story, NVIDIA smashing records, adding $277 billion to its market cap in one session. The company on the verge of joining an exclusive $2 trillion value club. Marky Patel of Allspring writing this: NVIDIA's results not only relieved uncertainty about NVIDIA and AI growth, but also resolved investor concerns about the health of the technology sector and economic growth overall. Margy Patel, I'm pleased to say, joins us now for more. Margy, let's go with Pete's line. I'm reloading to the full bear mode. Margy, are you?
No, I think this shows that the economy is strong, or at least strong enough to have a pretty good results for the whole year. And I think a lot of people were just waiting on the sidelines. This affirmation, I think, is going to open the floodgates for a lot of that money sitting on the sidelines, as it's okay to come into the market.
Now, do you think that much money is coming into the market, or is this, to me, I'm a little bit concerned everyone was already piled in, and this was a sigh of relief that everyone had already bet on this and was hoping for this?
Well, I think people actually were expecting a disappointment and a big market correction to go through the whole market. That didn't happen, so we saw a quick reversal. And I think that mentally people are still thinking we're locked into some kind of an economic cycle precipitated by the Fed. The market has not been very sensitive to what the Fed has done. The market's looking at the numbers, at revenues, and also at margins, which have still held up. And these sectors in the tech sector are very, very strong. That looks like that's going to continue. So I don't see any reason why we should get a meaningful correction. We may chop around, but I'm not looking for much of a correction.
And will this start translating into a broader market rally like we had in November after NVIDIA earnings then? That was what seemed to precipitate the rally in the Russell 2000 and stocks as a whole. Can we expect that sort of thing right now? Or is this still going to be maybe a tech-led rally?
Well, I don't know if I'd say exclusively tech. I think it's going to be a narrow market to those companies that have above average growth. So that would be tech, because they've shown that. I think a number of industrial companies were very, very strong, and I think they're positioned to be on a secular increase. It's a sector that's rather undervalued. And also in the healthcare sector, parts of that look like they've hit bottom and are ready to do a little better. So broaden out, but only to companies that have good earnings growth.
Margy, you mentioned the Fed, and I find it fascinating as well. The front end of the yield curve has repriced 50 basis points. Since the last day the Fed met. At the end of the close, I think we're at 420 that day, through 470 in the last couple of sessions. Margy, why do you think this equity market is now willing to de-emphasize the importance of what is happening at the front end of the yield curve?
Okay. Well, because I think really when you look at a market of interest rates, roughly say 4 to 4.5% for Treasury rates, that really shouldn't be an impediment for economic growth or for good returns on equities. So I think the market is disregarding it. So many companies have restructured their balance sheets, and they really aren't sensitive to these little tweaks that the Fed is doing. I think the Fed would like to be more relevant, but they really aren't when you look at margins. There's really no sector that you can say is so vulnerable to Fed increases that could cascade into a recession. So things look pretty good, and the Fed is on the sidelines trying to be an important player in this.
They're patient, apparently. They're not in a rush, and we'll talk more about that a little bit later. Peter Cheer, Marko Kolanovic of JP Morgan seems confused about this. I don't think he's the only one. If you think about how this rally started at the end of October, this was engineered by this idea the Federal Reserve was about to pivot, that we'd get maybe 7 rate cuts in 2024. We're pushing that out. We're reducing the amount, so the timing and the magnitude has changed, but this equity market, Pete, has carried on rallying. What explains that?
It's kind of rallying because yields have been...
No, Peter Cheer, please.
Sorry, yields have been going higher for the right reasons, right? We're seeing job growth, the economy seems to be holding together. So I think the markets can do well if we're rallying for those reasons, rather than when yields go higher because we're worried about deficits. I think that's going to be a problem that comes and hits the market in the coming weeks and months as we go through the election campaign and yields go higher for the wrong reasons. Right now, yields are going higher because the economy seems to be doing well. Equity markets can rally on the back of that. Again, to me, though, it's been a little bit too narrow. Even you go through yesterday, markets were up 3%. Most stocks were up 1.5%, 2%. I don't like that. I want to see the full-scale rally where Russell 2000 outperforms everything.
Margy, you wanted to jump in. Please do.
Well, I just don't think we can look for a classical kind of recovery the way we've seen in other cycles. All our cycles previously have been driven by the Fed, so we mentally think we should see this rotation in the markets and in sectors. It isn't happening. Economic growth has been at least moderately strong. It certainly isn't fading that much. It may be slightly below that 3% level, but that's still good enough to produce double-digit equity returns over the whole year. So I'm not worried about interest rates. As I said, 4% should never be an impediment to economic growth or good returns on stocks.
Margaret, you can make the argument that the US economy is strong, but relatively speaking, Europe's been absolutely dreadful. We've talked about the GDP in the UK, negative. In Germany, negative. In Japan, negative. And yet you look at the equity markets over there, we've got all-time highs in Europe in the last 24 hours. Germany on the DAX, France on the CAC 40, and even in Japan, we're talking about record highs there. Numbers we haven't been talking about since 1989. Margie, how do you explain that one?
Well, I think number one, the competition from interest rates is so low, people do look at equities. And also there are signs of, I wouldn't say vibrant growth, but a little bit of signs of growth that even in those countries, you know, Japan, England, Germany, that have had a little bit of negative growth, that it may in fact modestly picked up. And just a modest pickup is really all we need to take stocks higher.
And I would just add that most of these companies are very global. So the U.S. companies, 50–60% of the earnings come from U.S., most are foreign. You look at the foreign indices, they're made up of companies that really benefit from the global growth. So I think it's really hard to say UK companies in the UK index are really
I totally
UK
agree,
anymore.
Pete. The struggle I've got, though, is when we talk about global growth, what are we talking about? Whose growth?
You know, I do think people have been shoving money into equities because it's quote-unquote the only game in town. What I find really interesting is I've been getting long China. It's starting to rally a little bit. And my theme, I think we're going to put out a note this weekend, is everyone says don't fight the Fed, but it's okay to fight the Chinese Communist Party. If the Chinese Communist Party wants those stocks to rally, I think we are going to see a massive short squeeze in China. I don't think it's investable long term, but I think for a trade, that's probably my favorite foreign market right now.
9 days of gains on a CSI 300. I think the longest daily winning streak going back to 2018. A note dropped in my inbox this morning. SocGen, is it time to turn more positive on China? You're not alone. We'll catch up with Jay Pilowsky a little bit later on this morning. Margie, can you give me your call on what you think about what is happening in China right now? We know based on our reporting that they're restricting selling, net selling, around the first 30 minutes of the open and the last 30 minutes going into the close. Margie, is that sufficient to say this is a trade now? They don't want people to be short?
Well, I think that when you look at the Chinese economy, clearly there's strong trends continuing to decelerate, and I think that is the long-term picture of China is slower and slower growth, less and less competitive compared to other economies. So they can tweak it here or there, they can put those restrictions on, but it just seems fundamentally there are better places to invest your money for long-term. China's, I think, in a slow motion downward for a number of years.
Margie Patel of Allspring. Margie, great to catch up. Fantastic to hear from you on a record-breaking week in this equity market. Equity futures on the S&P 500 just about unchanged after closing yesterday at an all-time high on both the S&P and the Nasdaq 100. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. Here is Shonali Basak. Hey, Shonali.
Good morning, John. That huge rally in NVIDIA shares has catapulted CEO Jensen Huang to new heights. He's on the verge of becoming one of the 20 richest people in the world. Huang's wealth jumped $9.6 billion yesterday to more than $69 billion, and it's a gain that leapfrogged him ahead of Charles Koch to 21st place on the Bloomberg Billionaires Index. And AT&T said a widespread outage that took hours to resolve on Thursday was caused by a, quote, incorrect process while expanding the wireless network. The software issue had interrupted service for hundreds of thousands of subscribers and prompted the FBI and the U.S. Department of Homeland Security to investigate the outage. AT&T said all wireless service was restored on Thursday afternoon. And for the first time since 1972, the U.S. is back on the moon. Intuitive Machines landed a robotic spacecraft nicknamed Odysseus on the moon's surface Thursday afternoon, and it's the first private flight firm to successfully place a vehicle there. Following the landing, NASA's administrator said in a webcast, "Today is a day that shows the power and promise of NASA's commercial partnerships." And that's your Bloomberg Brief, John.
Hey, Shonali, thank you. Very, very cool. Can we just pick up on that AT&T story? I think we were down for about 9 hours yesterday. Anne-Marie, are we now ruling out a cyber attack?
Well, this is what the Homeland Security and the FCC is going to be looking into. Was this a cyber attack given this outage for hours that happened in the middle of the night and then extended through people's morning. At this moment, the U.S. administration wants to look at everything. Remember, they have been dealing with cyber attacks across, and I've been talking about them, across U.S. industries, whether it's pipelines, whether it's cloud computing, AT&T. This is a concern for the U.S. government.
Wally Adeyemo, the Deputy Treasury Secretary, joining us a little bit later this morning. We're going to be talking about sanctions on Russia, but we'll try and squeeze in some questions about that as well. We'll catch up with Wally at about 8:45 Eastern Time, so about 2 hours and 30 minutes. Equity futures right now on the S&P, as I say, totally unchanged. Up next on this program, the last two Republican candidates going head-to-head.
She's here. She's down by 30, 35 points, and everybody knows her. You're not supposed to lose your home state.
South Carolina will vote on Saturday, but on Sunday, I'll still be running for president.
That conversation just around the corner, live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
What a week. It's been absolutely exhausting for many of you. I think a week was just in a single day yesterday, with the S&P 500 up to all-time highs, on the Nasdaq as well. This morning, bit of calm for you. Unchanged on the S&P. Yield higher by a couple of basis points on a 10-year, 434.26. Under surveillance this morning, the last two Republican candidates going head-to-head.
She's down by 30, 35 points, and everybody knows her. You're not supposed to lose your home state. She's doing very poorly. She lost in record numbers in Iowa, record numbers in New Hampshire.
Many of the same politicians who now publicly embrace Trump privately dread him. They know what a disaster he's been. South Carolina will vote on Saturday. But on Sunday, I'll still be running for president. I'm not going anywhere.
She says she's not going anywhere. Well, here's the latest. Voters in South Carolina will head to the polls for this weekend's GOP primary. Nikki Haley trailing Donald Trump by around 30 points in her home state, according to the latest polling. Haley is vowing to stay in the race no matter the results. That is a change. Matthew Bartlett of Derby Field Advisors joins us now for more. Now, Matt, let's get straight into this question, a question that Nikki Haley herself is struggling to answer. What state can she win, if anyone at all?
That is the right question, and there is no right answer to that. Listen, it's been a wild ride on Wall Street this week, but it's still kind of a rocky road on the campaign trail. Tomorrow, I think that clip just encapsulated this entire race. Flashback a week ago, you, Lisa, Anne-Marie, just did an amazing interview with Nikki Haley on critical issues, domestic, foreign policy. And then you saw Donald Trump, who continues to be something of a political pundit from the sidelines. Oh, and also the frontrunner for the Republican nomination. So it's just a very weird cycle. Nikki Haley in her home state looks like it's going to be yet again another loss, another defeat. But I think from her speech, from even yesterday, it looks like she is pivoting from a presidential campaign to much more of a messaging campaign, where she is going to continue to point out Donald Trump's either personality flaws or unorthodox policies.
So home sweet home isn't so sweet when it comes to South Carolina, but you didn't answer John's question. Is there a state she can win?
I think the old Canadian band said it, the night they drove old Dixie down, a Yankee's going to lay her in her grave tomorrow. No, there is not a place where she is going to win. Now, some people are saying, she could be running for second place in case first place goes to jail. A very rare, slim chance on that. I think she even ruled out 2028, saying that she knows her political future with the Republican Party is dead right now. So she's going to go out on her own terms. She's going out swinging. She's probably not going to win tomorrow or anywhere else. But she's going to go out on her own two legs. She's got a group of donors that appreciate her message, appreciate what she's doing, and she's going to continue on. Listen, in politics, it's always a fine line between a fool and a hero, between bravery and stupidity. And I think what she's doing now, we won't have a clear indication as to what it is, maybe until what happens in November.
Well, this is what a lot of Republican lawmakers and operatives are saying. Does she just stick around if former president cannot run? But most people in politics say you don't back out because you don't have the will to do it. It's because of the resources. So is her whole game here is to just build up a war chest for whatever she decides to do politically in the future?
Unclear. Yes, she has donors. Typically, you are so right, Anne-Marie, you got that right. Campaigns don't end because people don't have anything to say. They end because they don't have money. She still has money, and she still has some things to say about Donald Trump and Joe Biden, to be quite clear. But she is becoming, the Republican for Democrats. She is becoming the Republican for independent and moderate voters. That is absolutely damning when it comes to the GOP nomination. The base, the MAGA Republicans, they don't want that. It is about a feeling. She is adopting, whether it's a left wing, talking points or, about Donald Trump. It looks as if she knows this. She's doing it deliberately, and she, is going to go out the way she wants to.
From a market's perspective, I've been advising clients that this election cycle is going to be very, very different because normally we go through the primaries, then you get to the convention, and then the real election campaign starts. I think everything's going to be pulled forward this year because it seems like it's already decided now. Is that a right or wrong message to be giving to clients?
Peter, you're exactly correct. We have never, ever seen a scenario, a dynamic like this with two old, elderly presidents, one being the current and one being the former. So this is a very weird time where you're going to have, undoubtedly, a lame duck presidency coming up. So in terms of advising clients, in terms of what will happen in possibly probably a divided government, no matter who wins, it's going to be negligible, is what most people think. But beyond that, what you just pointed out, Peter, we are going into a rematch that most Americans do not want. And there are going to be a lot of these here. It's going to be a vindictful, a vicious, possibly even a vile campaign that ultimately will lead to victory for someone, that will be pretty bloodied up even after a win.
Well, you kind of killed my next question because I was going to ask, is there any way that this doesn't get very divisive and angry within the country? And it sounds like it's going to head that direction.
I think it already has. You have both parties absolutely dug in. Both parties cannot fathom a person voting for the other side, which is just an incredible dynamic. Forget two parties. It almost feels like you have two different species here in this town and across the country. It is polarizing. It is divisive. And again, let's remember, most Americans don't want either. And that's why I think Nikki's continuing to kind of pound away down there.
Which is just absolutely nuts. Matt, before you run, can you give us a number? What kind of spread are you looking at? How big is that gap going to be when we get the results from South Carolina? We're talking 25, 30 points, maybe more?
30 points, and I'm still taking the over.
Wow. Matthew Bartlett of Derby Field Advisors, thank you, sir. Describing Nikki Haley as the Republican candidate for Democrats, which is certainly not how you're going to win a primary for the Republican Party. Pete, we've had a conversation in the last couple of days. It's a conversation that I think Lisa is really focused on, really focused on. The policy and the policy gap between these two individuals we're all focused on. How business-friendly is this Republican Party going to be if they take back the White House?
You know, I think it's going to try and be business-friendly. What I'm increasingly concerned about is as people digest the campaigning, we're going to realize the deficit is going to balloon, and it doesn't matter which party. The Republicans are going to say, we're going to cut taxes and do various things, and that's going to keep the budget in line. That's not going to work, I think, in people's minds. The Democrat side is coming at a spending angle and saying the spending is going to help the economy so we don't have to worry about the deficit. I think the deficit is going to become a huge issue again, just like it was in September, October, as people realize neither party cares about the deficit.
Because they all want to spend, and they all add to the deficit.
One way or the other, it's either by spending or by reducing tax, it's going to grow, and I think that's what people are going to realize, and that's when we get another wave higher in bond yields, and that's the wave higher that's going to be difficult for equity markets to digest.
Okay, pause. You think we can retest the highs of last year?
I think so.
Again, at the long end?
I keep thinking that this reminds me a lot of what happened in 2006, 7, and 8 in the mortgage market, where you had things crack and come back. I think last summer and early fall was the first time the Treasury market had cracked. It was for sale every single day. It didn't matter what economic news came out. Treasury yields went higher, bond prices lower. That was the first crack. We resolved it. I think we're going to see cracks like that appear again.
I know the 20-year auction is a bit odd, and I feel like I'm taking on Lisa's role because she's not here, but does it hint at the Treasury's issue with issuing longer-term debt?
I think there's a lot of chatter now. Do they have to do something with quantitative tightening? Do they need to do some sort of Operation Twist to, reshape the yield curve? Yeah, I think people are going to start saying, wow, it's never going to get better. We're going to issue more and more debt. And maybe you go through periods of time where, okay, this quarter was great. We had tax revenues. It is getting higher. Yields are slowly creeping up. And people forget how long it takes for the average coupon to go higher for someone who issues so much debt with such long. That's all happening.
What happened to that wall of yield-hungry buyers that were going to step in when a 10-year gets to 450? What happened to them? They go quiet?
They do go quiet. And everyone, I always kind of think about, everyone says they want to back up the truck. When Treasury's at 4, if they get to 4 1/4, I'm going to buy. Yeah. Well, that's assuming they get to 4 1/4 for no good reason. You get to 4 1/4 for a good reason, and we're starting to slip. I think we're going to get to 440, 460 as the next range, with a real risk of going to 5 rather than back to 4.
Interesting. Pete, stick with us. Pete's going to be with us through the next 30 minutes. In the next hour, we'll catch up with Earl Davis of BMO, also looking for high yields at the long end. And just another programming note for you. Record highs in the equity market, not just stateside, but in Europe too, both on the DAX in Germany and the CAC 40 in Paris, France. And also, big winning streak over in China, 9 days of gains. Jay Poloski of TPW has been waiting for that victory lap moment on China. Well, he's had 8 or 9 days. He's going to catch up with us at about 8 a.m. Eastern Time. Coming up next on this program, more on NVIDIA's record-breaking day. Live from New York City, you're watching Bloomberg TV.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is a snooze compared to yesterday. Equity futures on the S&P 500 going absolutely nowhere, following the biggest one-day gain on the S&P going back to January of last year. Equity futures on the Nasdaq down by about 0.12%. The Nasdaq 100 just inching a little bit lower, heading towards, and we're well on course on the S&P for a solid week of gains. If you get to the bond market, switch up the board and take a look at the 2-year. Wow, have we repriced. Inching higher, yields up for a fourth consecutive week, up another 2 basis points, 4.7327 on a 2-year. If you go back to the end of January, the Federal Reserve meeting, the close on that Wednesday, we were looking at 4.20. The 2 years repriced by more than 50 basis points, and yet still this equity market has carried on rallying, which has just been absolutely phenomenal to see. Want to finish on foreign exchange just briefly and take a look at the euro side of things. The IFO index out of Germany, not that bad, not great either, but certainly it's a low bar in Europe, as you've seen with the data all week. 108.29 on the euro at the moment, just a touch stronger on that currency pair. The euro firmer by 0.06%. Under surveillance this morning, the magnificent one stellar week continues. Nvidia shares surging to an all-time high yesterday, the biggest single session gain in market value ever. Shares jumping 16%, adding about $277 billion in market cap and bringing the chipmaker's total market value near $2 trillion. Nvidia's surge surpassing the $197 billion single-day gain made by Meta only 3 weeks ago. Peter Cheer, stellar run. And great to see you, because you've got a refreshing call. Never mind jumping on the bandwagon, full bear. For the people just tuning in, can you give us a snapshot as to why you are turning in the other direction?
So I haven't liked the price action probably since early February when we saw that crazy move in Meta. Again, anytime something moves $200 billion, as you said, at McDonald's in one day, you watch it, things were weak. I shudder to think what would have happened if Nvidia missed. We were down 3% basically coming into that. It rebounded, and it felt awful out there. You were starting to see a lot of zero-dated expiration options pushing for this on the put side. And yes, we're at all-time highs, but the NASDAQ 100, I think, is 18,000. It was 17,970 a week ago. So let's not get carried away. This saved the day, and I have this feeling that within the next day or two, everyone's going to be like, okay, so what's the next catalyst? What takes us higher? And I think this whole money on the sidelines, the money's been added to the market. It's been put, dip buyers. I think we're fully invested. I think we're susceptible to a pullback.
How do you get a read on that? Can I just ask that question? Because this was described going into the print as one of the most crowded, if not the most crowded trades on the planet, and yet seemingly there were people who weren't in this trade.
So part of that was last week, it was at 694 or something like that. So they'd already had a bit of a pullback. The other problem, and this is where I think we all have trouble dealing with a company like NVIDIA, where its weighting in the index is much greater than most money managers can get comfortable. A lot of money managers can only be invested, say, 5% in particular equity. So weirdly enough, even a lot of the NVIDIA bulls are probably technically underweight versus their index benchmarks. So I think that causes a weird dynamic where people have to chase it even if they're already long. And again, yesterday would have been more concerning to me, and I may be turned very bullish, if you saw other names up 3-4%. But I looked across the board. A lot of the other big drivers were up 1.5%, 2%.
Sure.
It wasn't a widespread rally. This was people getting squeezed into the markets, and it was lackluster. It kept going up during the course of the day. Look where Meta did after their big gain.
Yeah.
They were lower up until yesterday.
Stock is up again this morning, up by 1.4% on Nvidia. I promise we'll talk again about AT&T, so let's do that. Saying a widespread outage, which took hours to resolve yesterday, was caused by a, quote, incorrect process. I've no idea what that means. While expanding the wireless network, the software issue interrupted service for hundreds of thousands of customers and prompted an investigation by the FBI and US Department of Homeland Security. AT&T said all wireless service was restored by the afternoon. 9 hours after it first went down. AMH, we were thinking about this. I think people are talking about this. Have we pushed aside the idea this was a cyber attack?
So AT&T is trying really badly to push it aside. And to your point, Jonathan, processing error very much feels like, to me, turn it off, turn it on. There seems to be some sort of engineering failure. But the federal government, according to our reporting, is looking into this, whether or not this was a cyber attack. So Department of Homeland Security is going to be involved in this. The FBI, the FCC, they are not going to put that aside. And what's so concerning is similar to our discussion yesterday with the head of the LA Ports Authority, China infiltrating infrastructure.
Pete, you've got generals on the team at Academy. What did they say to you yesterday?
Yeah, so we have 3 or 4 who are very cyber specific. They are being asked by everyone what's going on. What we can say is everyone's clearly questioning, was this a cyber hack, was it not? So far, there's no indication, but it is a really good reminder that we kind of live in this world where I think we view cyber as this digital. Oh, I lost my ID or something. The risk of it going from digital to physical is real. We saw it with the Columbia Pipeline, I think, as you mentioned earlier. This is going to be real, and we have to figure out how do we deter properly. Instead of all we have is kind of name and shame, we have to figure out a policy that at a national level is, what do we do if we're hacked?
It's a great point, because at one point, when you talked about China and cyber, it was, say, a hotel company worried that their data would just be stripped of all these guests that arrive. But then when Colonial Pipeline happened, you actually saw this massive